Okay, team, I'm putting together my plans. I'm having a little bit of technical difficulty. I'm trying to do the best I can. I'm having some technical difficulty already today. Hope everyone is doing well today. The market is in a mess. Give me a minute, guys. I will get it together. Very interesting day today. I don't like any calls. I just like the opportunity to short a higher low. So I like to see a bounce to the 667, come back down to the 666, and then let's grab it and take it on down to the 662.5 and the 659. Move those over. See what that looks like here. I need the fiber guy. I'm having some technical difficulties. I need my guy. As far as a call is concerned, I don't know what to tell you about a call. Let me look, see if the team put anything. I can't see the chat, so I'm having to look. I'm having to look at the same time to see the chat. Todd Maker's in the building and Kosie's in the building saying good morning, everyone. Thank you guys for being here. And thank you for hitting the like button. We got 6 people in the building. Thank you for hitting the like button. Please excuse me. I'm having a little bit of difficulty this morning. We're going to get it together, though. Yeah, I'm all the pieces. I don't know what I'm doing. I don't know how this thing works. Still in this control algo as we start today. That's what we're looking at. We identified this yellow controlled algo. Bear with me this morning, team. I got a little technical difficulties going on over here. That's what I wanted to see. I wanted to see that bounce back to the 677, and then I wanted to see me take that put at the 666. Let's call it $666 area. You hear me? Yes.
kick stream key?
Yeah, the stream key is gone. There's the put right there, guys. There's the put right there. Let's get a candle close, and then I'm in the trade. Thank you guys for keeping the chat going. I can see it now. One problem down, one to go. Is anybody else in this already? Good morning, team. Good morning, Dr. JB, Quiet Soul. Good morning, Nkosi. Good morning. Grateful day to you guys. $668 put. Beautiful work, Dr. JB. I believe I caught a 667 put this morning. 667 put. Off that bounce. Wanted to see that bounce back to the 667. Grab it at 666. Looking for 662.5 and then possibly 659 today. All right, at least I got the chat up. I'm here with you guys, that's for sure. Let me show you the trading view chart. This is what I'm looking at on trading view. I believe we can come all the way down to the 659 today. Next profit target is 662.5. Hey Abdul, since it happened quick, you want to retest at 666? No. It's not coming back to 666, Ben. No, sir, Ben. I don't believe this is coming back, sir. I believe it's going to get even uglier. Why don't I move this now? You got to be kidding me. Just taking up the whole screen. I can't get to another chart. Jody. I can't minimize the screen to be able to move this thing now. Getting a bounce right here. Very interesting. I have to look for a clear setup right now, Ben. Ben said, so if we didn't hop in at the jump, what do you think we should get in? Ballpark guesstimation. I'll wait till the 10 o'clock candle, Ben, and look at the next 30-minute candle. I will wait till 10 o'clock and look at the next 30-minute candle and look and see if you see an entry on that. If anything, right now you would be chasing and you wouldn't put yourself in a good position. Wait till the 10 o'clock candle and then see if we break the low of the first 30-minute candle, which is 663.3. Yes, it is, Ben. Huh? Say it again. Yes, Ben. In my opinion, team, let me know what you think. But I think if you missed this and you didn't get in at the jump, you need to wait for a higher low. You need to bounce, let it put in a higher low. But no one knows what the market is going to do. Maybe it might not bounce. No one knows. But we don't want to predict. We just want to react. Fact of the matter is, the train has already left the station. We're down at the 663, but it's still early today, and I believe we can go down even further. But I will wait until 10 o'clock, see if we get a bounce, and then short a higher low, in my opinion. The chat is open. Tell me what you think, team. Dr. JB said maybe it's too late to get in right now. I agree with that as well. If you do, you'll be chasing. Allow the trade to come to you, get that higher low, and then take off. Okay. Gosh almighty. Here's that 662.5. Coming up on the horizon. Damn, look, they could be trying to figure this out. I still stand by that bend. Let's get a higher low. Contracts are too expensive to play with. Take quality trades. Great advice, Jesse. Great advice. Contracts are very expensive right now. The 668 is looking great, Doc. You still in it? Dr. JB, you still in that? Good job, Ben, for not chasing. Good job, team, for those of you who weren't in that trade, for not chasing. This could be that potential lower high we were looking for. Let's see what happens here. On the 15-minute chart, it is showing us a potential reversal. We have let's blow this up. Let's talk about this. On the 15-minute chart, we're showing a red hammer. This could potentially be a bullish reversal signal. A green hammer is stronger than a red hammer. Nonetheless, you still have bulls who are rejecting lower prices from the 662.7 going higher. If these bulls now get in a position that is very uncomfortable, then they will have to cover their position. If the price is able to come back down to 663 and lower, these bulls will start covering and potentially break the 662.7 low. That would be a safe entry for a continuation to the downside, as this is essentially potentially a higher low. I mean a lower high. We won't have confirmation until or if the stock market comes back down towards 663. Exact same thing happening here on a 5-minute chart. Bears are rejecting 664.9 and above. Bears have come back in at 664.9 and are rejecting that. If the bulls are able to get back above 664.7, these bears will start covering, and this could potentially be a nice bull scalp. But you want to let this candle close to be sure. We are still red for the day. We still have a monstrous gap down. The market is still bleeding, and we're simply searching for a lower high. But please beware. Even 62 call. Thank you. Team of doing. I'm not in a freaking relief. Looking at a 663 call, 662. Dr. JB said he's looking at 664.7. They're looking real strong, as these bears will have to start covering. And that is potentially what's happening now. 2 minutes left on this candle to let it close. Once you let that candle close, up there it is. Bam. Just like that. Just like that. Y'all back over at 664.7. It took off. Again, we saw this move on the 15-minute chart, called the setup on the 15-minute chart with this beautiful red hammer, showing you the potential of a nice bullish move. But again, still recommend letting the candle close on the 5-minute first. This is a great lower high here. Good scalp move by you, Dr. JB. Great scalp move, as it did present itself. That clearly was a little high. That clearly was the lower high. Clearly. Did you get it? Did you get in it, Ben? Way to go, Bigfoot. Way to go, Jay. Thanks, man. You deserve it. I did not go on the call. Hold on to your foot, yes. Did you get in your put, Ben? That was that lower high we were looking for, with a beautiful bearish engulfing candle here on the 2-minute chart, here on the 5-minute chart. And as I stated before, coming back down to that 663 now puts those earlier bulls in a very uncomfortable position. They're trying to fight. They're trying to fight, but they're in an uncomfortable position right now. Beautiful bounce, Ben, back, and the rest of the team back up to the 66. We want to get a close below the 663 and then get in on the next candle. If you didn't get in on that bounce, on that lower high, beautiful opportunity here. If you missed that, you got to wait for the 663 break. You need to close below 663 first. Then the remaining bulls will start covering below the 663. But you can see they just stepped back in here again. So that 663 is a little bit of a demand area right now. Be careful here. You need to see a close below it, depending upon which candle you're looking at. But if you're looking at the 5-minute candle, you want to see it close, body close below 663. I had 2 algos drawn this morning. That bullish algo right now has been invalidated, taking that off the chart. We're now still in this control selling algo, and a very aggressive one, I might add. Let's go there. Let's take this off. Again, we want to see that close below that 663. We said that 663 is turning to an area of demand. Let's go ahead and mark it off as such. Okay. That is an area of demand. We want to see a close below this, and then you can look for continuation. First profit target was hit. We called out 662.5, and the market did come down to 662.4. Second profit target is 659. bouncing today. Yep, it does appear to be bouncing. Beautiful red hammer at demand. Could be a nice potential scalp. Right now it's back to the 5. Could possibly go to the 20. Thank you, team, for being here. Jesse and Kosi, Quiet Storm, Big Ben, Dr. JB, nice to have you back with us. We missed you, man. Jared Lewis. I do have to apologize for the kick watchers, as technical difficulty wouldn't allow me to multi-stream today. We'll keep pre-market up because with such a gap, Friday's action is of no relevance. So we will keep up today's action. Today's pre-market. Let's see what CNBC. I'm sure it's going to be pretty entertaining today.
Wasn't I think oil and gas are here to stay. You know, they've represented over 80% of the global energy supply for decades. Tortoise, we don't see that changing. We continue to see oil and natural gas in particular, representing a large portion of the global energy supply for the decades to come, especially with AI, because AI is going to be an important driver of the future economy, and natural gas is going to be an important future driver of the economy in an AI-driven economy.
Rob, appreciate it as always. Rob Thummel over at Tortoise. Thanks so much.
Thank you.
Much more on energy ahead when Goldman Sachs' co-head of global commodity joins us next hour. Plus, the broader market reaction to the war in the Middle East as stocks fall here and volatility spikes. Veteran investor Ruchir Sharma will weigh in. And then surging gas prices, not the only headwind hitting the airlines. More on the chaos across TSA lines across the country. Don't go anywhere.
Welcome back. Travelers across the country facing massive delays as the Department of Homeland Security shutdown impacts TSA staffing. Phil LeBeau is here with that story. Good morning, Phil.
Mike, have you seen the videos? Because if you have, you're looking at them this morning saying, what? People are waiting several hours to get through TSA security? That is the case in different places around the country. We saw this video from yesterday. This is New Orleans. That is a parking lot. That is people waiting to get through security stretched out into the parking lot. And we saw long lines at Houston, a few other airports around the country. Atlanta also had long lines. It's not across the board, but where it's happening, people are saying it is ridiculous. So here's where things stand in terms of lack of TSA staffing causing delays. It depends on the airport. Some airports are fine. Yesterday I flew out of O'Hare, no issues at all. Other people I know were flying out of Newark, they had long lines. Several hour waits are possible. And we're not exaggerating when we say several hours. Houston Hobby on social media was telling people, get to the airport 1 to 2 hours ahead of when you're usually supposed to get there. And we are approaching peak spring break travel. Basically, you're going to see busier airports. And as a result, it has a lot of people. This, along with what we're seeing with jet fuel prices, has a lot of people saying, what can we expect in the first quarter from the airlines? And that's why you see the airlines once again trading down anywhere between 5 and 7%. We probably will get some adjustments on Q1 earnings estimates when we start to hear from the CEOs within the next week, week and a half. To what extent remains to be seen. I think largely that's dependent on what happens with jet fuel prices. The Q1 guidance, as you take a look at the airline index, this says it all. This is what's driving how investors are looking at the airline stocks right now, down 16% this year, likely to fall a little bit further if we see an extended period with higher jet fuel prices. Guys, you don't want to miss the interview we have coming up next hour. We're out here in San Diego at the ISTAT conference. This is where all the aircraft leasing companies come together with leaders in the industry. That includes Robin Hayes. He is the CEO of Airbus North America, former CEO of JetBlue. He's been through a few of these jet fuel crises. We'll talk with him about the state of the industry, what he's expecting and what he's seeing and what he's hearing from those who he deals with, because they're selling these aircraft. They have record production. Things should be good for 2026. And now you've got a first quarter that a lot in the industry are questioning what we will be seeing from the airlines. Guys, back to you.
Over the weekend, Phil, I know Mealy has put some numbers on the group as a whole, bringing down net income by 10, looking at jet fuel. I guess, is hedging no longer an exercise as common as it used to be?
It's rare. You used to see hedging, I'd say 20 to 25 years ago, you would see a lot of hedging. Southwest, they were the kings of hedging. You would see it every quarter.
Penny perfect, literally penny perfect as far as following the algo. We were able to identify that control selling algo. The market went right back up to the top of it. And there again, did the bears come back in, putting in another lower high. We have to, however, be careful. And again, if you didn't get in at the lower high, because the market gave you another chance to get in at that lower high, using the break of the high as your stop. If you didn't get in, then you're going to have to wait for a break of demand. So wait for the break of the 663. I'll give you a demonstration of what I want to see. This is it right here. This is what you want it to look like. And then your entry will be here in that 662.7 area for a put. Other than that, it's dangerous. New 30-minute chart on the horizon. This 30-minute chart is telling you everything you need to know. Doji followed by another doji. Truly in decision right now.
Major episodes going back to 1950, we typically see a decline in the S&P of around 4%. Now, usually after a month, the S&P tends to recover that entire decline. But the probability here is a bit different, I think, because the reason why this threatens to be worse than the average is because even before we went into this conflict, I think we had other problems brewing for the market, which is principally what's happening in the credit markets. So therefore, I feel that this has been the catalyst for a major de-risking move. And even if we do get some cessation in hostilities in the Middle East, I think there's been a regime shift here for markets, and it's going to be quite hard for them to recover and make new highs anytime soon.
Do you think the movement in commodity prices will then lead to a tightening of conditions that lead you to credit events?
Yes, I think that's exactly what's going on, which is that, we had spoken about this late last year, Carl, which is that my own view was that the AI trade was, like entering a bubble phase, and that every single bubble in history ends when you end up getting a tightening in financial conditions. It doesn't have to be interest rates, but a general tightening in financial conditions. And I think that's what this commodity price rise is leading to. And this is why this is a bit different also from past episodes, because whenever you ended up getting some sort of a shock to the market, you thought you'd get an easing of financial conditions via the Fed. I think the Fed's out of play this time because they've missed their inflation target for 56 months in a row. Core inflation still stuck at close to 3%. So I don't see the Fed riding to the rescue anytime soon either. So that's what's complicating the market's narrative further here.
And Ruchir, in terms of the relative performance, U.S. versus the rest of the world, we've obviously seen that reverse to a fair degree. It felt like there was, coming into this year, this sense that there was early cycle tailwinds kicking in for the rest of the world, this global reflation trade. Has that been reset, or has that now been called off?
Well, I think it's been suspended, and it's been suspended for two reasons. That if you see what's happening in the markets around the world, there are two effects which are really going on. One is a simple degrossing effect, that whatever the winners were of the past few months have suffered outsized declines. This goes with market performances around the world, sector performance, and even some of the stock performance, right? It's been a simple calculus as that. The second effect has to do with the oil effect, which is that the countries which are much more exposed to importing oil have been hurt far more. And in that regard, the US is a relative winner simply because of the fact that the US is not that exposed anymore to oil developments around the world, given the energy self-dependence here. So I think that is what's causing that. So yeah, if the conflict lasts a lot longer, I think that's a problem. But then I also feel that people begin to ask questions about US leadership then, that if this really goes on for a long period of time, that what exactly was the US doing out here? And, like how do we trust the administration given what it said? So I think that this is a temporary sort of pause in the US outperformance, which we saw from the last 10 days or so, which is that I still feel that we have hit peak American exceptionalism. That is what we hit in December of 2024. And for the next few years, that's still going to be the big trend.
Although dollar's been up every day on this war, and everyone hated the dollar. Everyone counted out the U.S. and the end of U.S. exceptionalism. And guess what? The dollar has been the place to be since this all started, which is interesting, Ruchir, at a time where treasuries have sold off. So what does that tell you about demand?
It's a bit of a mixed reaction, Sarah. I mean, you're exactly right about that. But as I said, that a lot of what's happened in the past week also involves degrossing, right? Which is that people, wherever they had extended positions, whether it's semiconductor stocks or it's got to do with the dollar short, as you rightly point out, all these things have been tightened back. But I think that what happens now is that the fundamental trend doesn't change, which is that the dollar had a pretty poor year last year in 2025, and then we now have this temporary setback, partly because of oil prices, because the US is just not that dependent on international oil. So I think that these are temporary effects. Now, if you tell me that no, this conflict is going to last for a while, I still feel that dollar comes into trouble then, because then people begin to question, as I said, that what exactly was this administration doing, getting so involved in an international conflict.
And then, Ruchir, you feel like we had peak American exceptionalism, but you're also concerned about China no longer really serving as a source of support for global growth?
Yeah, so that's the piece I wrote in the Financial Times this morning, my latest column, which is the fact that it's quite the opposite, which is that what China's been doing over the past few years is that it's dumping like never before. That, I think that, and this problem is, I think, a bigger problem than the tariffs for the global economy. The reason I say this is because of the following reason, which is that if you look at China, they are very reliant on their net exports for their economic growth and to meet their economic growth target. As a result, they are dumping a lot of their excess production on the world. And this is really hurting economies in many parts of the world, from Germany to France to Indonesia. All these countries are feeling the effect of Chinese dumping. That's because they're over-investing, overproducing, and the domestic demand is just not strong enough to absorb that excess production. Now, the problem is that all these countries have been so focused on fighting the tariff battle with the US that this problem has almost got overwhelmed by that. But I think that this is a bigger problem just because now, in fact, the Chinese export surplus has reached gigantic proportions, and never before in history has such a large economy relied on exports to grow as China is doing now. And this is a real problem for the global economy.
Yeah, although Merz and Carney have been going to Beijing, Ruchir, as they are maybe sick of being tariffed by the U.S. and looking for alternate allies. We'll see how it develops over time. Appreciate the help today. Good to see you. Ruchir Sharma.
Thanks, Scott. Yeah, thanks, Scott.
We do have some breaking news out of the G7 on oil. Pippa Stevens with the story. Pippa, what's happening?
Hey, Sarah. So the G7 meeting has ended, and we are getting multiple reports that they are not there yet in terms of a wider oil reserve release in order to combat this surge above $100. And additionally, sources telling CNBC contributor Michelle Caruso Cabrera that the G7 finance ministers stand ready to act if necessary, including a release of stockpiles, and that there will be a G7 energy ministers meeting tomorrow. So again, the meeting today has ended with no confirmation of any sort of release, but they are once again meeting tomorrow to discuss this surge in oil prices more. Guys?
Okay, we'll stay tuned for that, Pippa. Thank you very much. Coming up, the news sending Hims and Hers health shares surging and what Novo Nordisk has to do with it. We'll talk about that. This stock has been on a crazy ride. Stay with us. Welcome back. Major averages sharply lower, but well off their worst levels of the day. Here are three individual movers we're watching. Roche shares are under pressure after results out of a late-stage study for an experimental breast cancer treatment missed. the primary objective. Stock down 3.25%. Live Nation gaining on news that the company has reached a settlement with the DOJ in its antitrust case that began just a week ago. Sources telling Politico it will require Live Nation to pay $200 million in damages to participating states. And then check out the move in Hims and Hers Health, surging today on news. Novo Nordisk has ended its public feud with the company, announcing a new partnership to sell its weight loss drugs on the Hims platform. Unclear what this will mean for the investigations that the FDA has recommended to the DOJ on false advertising claims, but certainly think investors say it's a positive step that they're going to be selling the legitimate
That's right.
drugs.
It's a positive step unless you are one of the many short sellers who are in Hims and Hers and are
This
not
stock
having a
is
good
wild,
day
yeah.
with this pop today. All right, former Commerce Secretary Gina Raimondo is next with her read on what the administration can do to combat a surge in gas prices and separately new labor concerns when it comes to AI. And next hour, don't miss the CEO of Airbus North America, fresh off news that the company's expanding production here in the U.S. We're back in a moment.
Welcome back. Former Commerce Secretary Gina Raimondo writing in an op-ed over the weekend in the New York Times that the U.S. is facing an economic shock from AI and a new grand bargain is needed between public and private sectors. Former Commerce Secretary Gina Raimondo joins us now. Madam Secretary, it's great to have you back on. Welcome.
Thank you, Sarah. Good morning.
Good morning. We talk about this every day, wondering whether it's starting to filter into the data. We just got a weak jobs report. What do you think is happening, and what do you see based on your contacts with business around AI stealing jobs?
First of all, let me say, I think the promise of AI is exciting. You know, when I worry about the labor market impacts, the solution, I don't think, is to slow down innovation. We will get to an AI economy in some number of years that I think has more jobs, you know, new kinds of jobs that we can't even now predict. The challenge is the transition, you know, getting from here to there. And what I think this country needs desperately is a plan to get us through the transition to the other side without leading to millions of people being suddenly out of work, including, people up and down the pay spectrum, right? It's not just hourly wage folks. It's, lawyers, accountants, compliance people, auditors. So what I desperately want us to do is heed this call to action and say, everybody come together, all hands on deck. Let's create new forms of transition support, new forms of training, push companies to get more quickly to creating the jobs of the future.
Well, I mean, you're one of the few, if any, actually talking about a productive solution to how to do this. So what does that look like?
Yeah, well, I appreciate you saying that. Here's the reality. If you're running a company, if you're running a big public company, it certainly feels good in the moment to do a big riff and, send the money to shareholders. It is in no one's interest, no one, to have sky-high unemployment or to have the social, political, economic disruption that comes from that. So what I think needs to happen is we need to start experimenting with new forms of support, maybe wage insurance or other kinds of support to help workers transition from one job to another. Big companies really need to think twice, and we probably should incentivize them not to do massive layoffs. They should commit themselves to retraining and redeployment. I mean, we cannot allow the bottom to fall out, as we did with the China shock, right? We could have had a much better plan instead of getting rid of millions of manufacturing workers, and we are still, Sarah, paying for that disruption today, 30 years later. So what I'm saying is don't wait for the crisis to happen. Let's get ahead of it. Business, government, AI companies, get in. We can find the solution. If we spend trillions of dollars on creating the best AI in the world, we can find a solution to create the new transition support that we need.
Yeah, I mean, it's hard to imagine what that, if you're at a law firm, for instance, what that looks like. Or, a lot of these white-collar jobs, and we're going to talk next hour to the head of McKinsey, for instance, about all this. It's like the bridge between, the new jobs, if you believe the AI optimists, that will be created because of AI, and the jobs that just won't be there anymore.
I think there will be new jobs. Look, 15, 20 years ago, there were no cloud engineers. We didn't have as many. There were so many jobs, right? We didn't have Uber drivers. We didn't have all kinds of software engineers. There will be new jobs we can't now predict. And, I, as you know, spent a lot of my career focusing on our competition with China, our national security. We're ahead of China with AI. We need to stay there. We cannot, as a country, win the AI race unless we have a workforce transition solution as well. We will not be a strong country if we have double-digit unemployment, restlessness among certain populations. That will weaken our country and our ability to lead in the world. So I don't have all the solutions either, but what I know is if we all got together, we would find the solutions.
Secretary Raimondo, you mentioned trying to dissuade big companies from doing mass layoffs. What might that look like? And also, what about, looking to the actual developers of these AI models and put into place some kind of sense of how they might pay into whatever solution you conceive?
I think we should consider all of that. I think we need to do some experimenting, truthfully. I think we have to look at wage insurance so we avoid long-term unemployment. Folks ought to take a new job, even if it's lower pay, and we can make up the difference. I think AI companies should develop AI that creates new jobs. I think companies, big companies, need to start saying, okay, instead of just quickly laying people off, how do we forecast a year from now? Where are we going to see the job losses? And how do we today be proactive around the redeployment of those people, either in your own company or another company? The problem right now is we don't have any of these systems set up in this country, right? We've never done this before. So we have to get to work now, I think probably at the state level, to do some experimenting so that we can weather the storm that's coming in this transition.
Secretary Raimondo, I noticed that you attended the Munich Security Forum a few weeks ago, along with a number of other sort of stars in the Democratic Party, maybe with broader ambitions. Governor Gavin Newsom, Gretchen Whitmer, AOC. I'm curious how you, because you haven't exactly been on the party line at all times, how you view the current war against Iran and President Trump's overall foreign policy to reassert American dominance. Do you agree with it?
I do not. Let me say this. This war is hurting the American people, right? With folks, it's a fact, right? You know this. Every time you go to the grocery store, the bills are high. You pay your rent, the bills are high. Healthcare bills are high. Americans are struggling with affordability. And now you add on top of that energy and gas going through the roof. So with respect to Iran, and you see it now in the market, right? The market is starting to say, how long is this going to last? What's the actual end game? And so I think what needs to happen at a bare minimum is for the president to articulate what exactly are we trying to accomplish here and what is the plan to accomplish that, and swiftly bring this to an end, which is, really the only solution. That I know, you were talking earlier about oil and gas prices. There's no silver bullet. The silver bullet is to end the conflict.
I know, but I guess the argument would be short-term pain for long-term gain, getting rid of an evil empire that has killed Americans and other Westerners all over the globe for 47 years and chanted death to America. But the ultimate goal there is a good thing.
100%. There is no disagreement with that. Although the supreme leader has been replaced by his son, arguably the same regime. Certainly, the people of Iran have suffered endlessly, and to bring that regime down is a worthy goal. But I haven't heard anyone articulate exactly what is the goal, how are we going to get there, how will our allies help us, and how are we going to finally bring some stability to the region. Once war has begun, there is no clear endpoint. And I think what you're seeing in the market, the markets didn't crash last week. They're starting to, I think now, price in the fact that this could be a broader, longer, more uncertain war. And that is something that I think everybody, is worried about.
Yeah, well, we're tracking those market developments closely. Secretary Raimondo, thank you for joining us on the op-ed and on the world. It's good to talk to you. Gina Raimondo, the former Commerce Secretary under President Biden. And crude oil, she's right, is spiking. It's up 11% right now. However, stocks are coming back a little bit.
Yeah, the AI winners have kind of stepped up. Yeah, Broadcom, SanDisk, NVIDIA are actually doing some work here to mitigate the losses.
Mike, we'll see you tonight, overtime, 4 p.m. Eastern Time. When we come back, or actually tonight, you'll have Jason Furman, former of the economic advisors. Coming up next on Money Movers, a lot more on the spike in oil with Goldman's co-head of commodities. Don't go away. Good Monday morning. Welcome to Money Movers. I'm Carl Quintanilla with Sarah Eisen here at Post 9 of the New York Stock Exchange. Watching crude today as levels hit the highest since June of 22. And we're joined by Goldman's co-head of commodities research, who sees some mounting upside risks.
Plus, the airline industry getting hit hard by surging jet fuel costs. But will that also trickle down to plane orders and manufacturing? We'll ask Airbus North America CEO Robin Hayes.
And keep an eye on bonds today. We're joined by one strategist who says they could signal a shift from an inflation trade to a recession trade, as some raise their recession odds today. As for the markets, we are off the session lows. A couple of sectors have crept into the green this morning, including information technology and energy. The VIX is below 29 at the moment, and the 10-year got close to 4.2 this morning, still holding steady at 4.15.
Yeah, strong dollar, too. Getting some breaking news out of the New York Fed right now. For that, let's get to Steve Leisman. Morning, Steve.
Good morning, Sarah. Yeah, the New York Fed coming out with its consumer expectations, and we get inflation expectations. And the good news is most of this done before the attack on Iran, and they remain steady for the 1 year, 3 year, and 5 year time horizons. Again, the survey taken between February 2nd and February 28th. Looking at it, they do remain steady at a somewhat high rate, near that 3% for the 1 year, 3 year, and 5 year, down actually a tick going into this situation with the spike in oil prices on the 1 year, but unchanged on the 3 and the 5 year. Expectations for food prices declined 0.4%, and rent was down pretty big, 0.9 percentage points. And rent expectations are actually at the lowest level since December 2024. That might bode well for the housing inflation component of the CPI. Gas price expectations, however, did increase 1.3 percentage points to 4.1%. And here's a chart that looks at how closely tied inflation expectations are at the 1 year level to gasoline prices. You can see they follow it pretty closely, and you might expect that to go up. However, when you go look at the 3 and the 5 year, less correlation there. So that's where the Fed will focus, but it will watch these 1 year inflation expectations. Earning growth expectations declined, but better news on the job market, where unemployment expectations also came down, along with concern about losing one's job. Households, their assessment of their current financial situation actually did improve. Now, as for the Fed outlook, you can see here at these charts that the outlook for rate cuts have come down. For the first cut, they're down. And really now we're looking at a September first cut. And we pretty much, guys, dialed out that second cut at 47%. You can still call it the flip of a coin. And obviously, it's about what you guys have been talking about all morning. Tell the economists and the Fed watchers how long this lasts, and they'll tell you what will happen with interest rates and whether there's a huge downdraft in jobs and a spike in inflation.
Steve, how are you gauging the risk of inflation expectations getting unmoored, so to speak, and how does it complicate the Q&A for Warsh once he appears before Congress?
Yes, I'm gauging all of that exactly that way, Carl, in the sense that we have to watch the 1, 3, and 5. The Fed will will follow much more closely the 3 and the 5. It will expect the 1 year to surge, and the question is whether or not it's losing credibility in the inflation fighting, and then it becomes a big deal for Warsh as to how they approach this. And that big deal, Carl, is going to be very, very tied to what's happening in the economy. If these February job losses continue, I think the Fed is going to be expected to cut rates no matter who's in charge there, even if you get a surge in inflation. But if it's a closer call, I'm hearing, and what I heard last week at the Monetary Policy Conference in New York was that it's a real wait and see on the part of many people on the committee.
Plus, I feel like you can always make the case that the spike in oil prices is temporary. I mean, it is a shock, but it is not the core of inflation. So if there's more worries about jobs right now, I think you still can make and we heard it from Stephen Myron here on the show on Friday, you can still make this case to cut.
Yeah, Stephen Myron can make that case, but I'm not sure that other people on the committee are buying that particular line of thinking right now, Sarah. Again, if jobs are losing 100,000 a month, that's a different story. But if jobs are flat to up and you have this surge in inflation, I do not think the Fed will be cutting under that scenario. That's not my gauge of where the center of the committee is. Myron has been an outlier for quite a while now.
Steve, thanks. Talking a bit, Steve Leisman this morning. For more on the surging oil prices and the outlook for energy in the event of a prolonged war with Iran, we're joined this morning at Post 9 by Goldman Sachs co-head of Global Commodities Research, Samantha Dart. It's great to have you back, Samantha. Good to see you. Were you surprised by last night's price action? How did that feel to you?
So we saw some escalation over the weekend, right? So we saw news that some Iran oil facilities were getting hit. We saw news today that Saudi is starting to curtail production. So this, number one, does not de-escalate the situation. And if you don't have de-escalation, the market starts to price in not just your regular gradual adjustment that requires a little bit of higher prices, but rather, hey, this massive shock might last longer than we think, so we need to move into demand destruction right now. I think this move in prices to above $100 a barrel signals exactly that. It's this worry that if this lasts longer, the market needs to have a little bit of a more aggressive correction in demand as well.
Is this east-west pipeline, can that be a salve of some point, any kind, even if it's only 5 of whatever, 20?
Right. So we expected that pipeline to flow a little bit more than what we can see in the data so far. We expected maybe something close to 3 million barrels a day of spare capacity, but the data so far is pointing to something closer to 1 million barrels a day. And the fact that Saudi is now announcing that they are shutting production down suggests that they are out of room to put the oil. And it matters because if they were able to just stockpile it and wait this thing out, then after the mess is over, they could send production out, so it would be a production delay rather than a production loss. I think the fact that they are announcing, yeah, we can't do much by the pipeline, and on top of that, we have to start shutting down, that sends a signal that, yeah, this is production loss.
Does President Trump have any options when it comes to fighting the higher oil prices?
So there is some SPR that could be used. Today we saw the headline that the G7 are
petroleum reserve.
Exactly. We saw the headline that the G7 are considering maybe releasing some of that, right? And they talked about 300 to 400 million barrels of release being possible. This is not certain yet, but this would buy us time. If you had that type of volume releasing to the market, that's worth about 18 days of this disruption.
On other types of commodities that go through the strait, the fertilizers and the sulfuric acids and the things that feed into crops and industrial goods, is that as big a concern as oil itself?
It's a growing concern. For example, if we move to liquefied natural gas in the same way that you have 20% of oil volumes crossing the strait under normal times, you normally have 20% of global LNG supply crossing the strait. And natural gas is a huge component in the production of fertilizer. So even out in Asia, we're starting to get headlines of producers of fertilizer having to shut down because they cannot access natural gas. One option would be to use naphtha instead of natural gas. But if you don't have enough oil, or if naphtha is too expensive, you can't do that either. So yes, it is a growing concern that it's going to impact other markets as well.
So how do you make a forecast on oil prices right now without knowing what the end game is here?
We have to work with scenarios, and I think this is, in a way, it's what the market is doing as well, right? This rally that we saw from last week, to your point, like the price action right now has stepped up. What does that mean? It means this increased concern with demand destruction, which also means that if we have headlines that suggest maybe de-escalation, some of that risk premium might come off. So the uncertainty about the duration of the disruption is really key here.
Ultimately, though, in a year from now, where do you think prices will be?
Well, we think that the prices will be much more normalized, but it's hard to escape a sort of long-term impact on stocks. This is such a large disruption that even if it's fixed after 4 weeks, yeah, we're likely to start next year with lower oil inventories than what we would have otherwise.
So there is a longer-term disruption here going on.
yes, it's not massive. It's something that we can compensate for over time, but it's just that the scale of what's happening now is just so massive. And if you think about how, for example, U.S. production could offset that, U.S. production can be very prolific. It's very cheap. It's short cycle, but even that short cycle is what, 9 to 12 months. It's a few quarters, right? So it's something that over time can show up and can respond to high prices, but not overnight.
Right, which kind of brings us to some of the commentary from Scott Sheffield last week, or even the backwardation that there's a belief this will get better, right? Among market participants, at least.
Absolutely. Yeah, it's just that because we don't know when, you end up having to price in a bigger demand destruction right now, just in case.
Samantha, thank you. Always good to talk to you. Samantha Dart over at Goldman.
Up next, how to think about oil and commodities as a risk hedge during the current volatility. Neuberger Berman's Holly Newman-Croft has that for us.
How could the move in oil impact airlines? Could a prolonged spike in jet fuel price slow down new production, let's say? We'll talk to the CEO of Airbus North America when Money Movers comes right back.
Welcome back. Stocks off the lows after an early morning pullback on concerns over the Iran war, the spike in oil prices. But our next guest says commodities are doing exactly what they're supposed to right now, providing diversification as traditional assets struggle. Joining us here at Post 9, Neuberger Berman Private Wealth Managing Director Holly Newman-Croft. So is it too late to make any kind of moves around what's happening now in commodities and stocks?
I think what's really important for investors to remember is that we've positioned their portfolios for long-term outperformance and to withstand short-term volatility and unexpected moves. So you really want to try to not have knee-jerk reactions to the headlines. Because as we've heard a lot of your guests say, I think the key right now is we don't know how long this conflict with Iran is going to go on. We don't know how long oil prices are going to stay so elevated. We've seen such a huge spike, up over 30% last week, up 12% or so today. And until there's some clarity, making a move that could have a tax consequence or something else for their portfolio, they need to remember that their asset allocation is a direct reflection of their risk tolerance. And that's really the most important thing for any investor.
So this doesn't make you wonder if clients should have less of a risk tolerance than they've had before? Because you were pretty optimistic about where we were in the economy and with growth and with AI and how the year was going to unfold. We didn't factor in necessarily an energy price shock.
We didn't, but it could be over in a week or 2 weeks. This is only, it feels like forever already because it's been dominating the headlines and everything you hear. But this is only the second week of the conflict. As quickly as it started, it could end. And there's a lot of international pressure. I know the G7 meeting today didn't have a resolution, but there's a lot of international pressure from friends and foes, China and Europe, to end this conflict and reopen the strait and get oil moving again. So
no big moves.
No big moves. No knee-jerk reactions. No, you want to take a 10,000-foot view, look at fundamentals. We are not, as a firm, changing our asset allocation outlook yet. There's nothing really fundamental that we're reflecting in those views. We continue to be overweight small and mid caps. We continue to be overweight emerging market equity and debt. We continue to like commodities in client portfolios as a hedge to inflation or concerns about inflation, and we're seeing that play out beautifully in this environment. And we're just going to continue to watch the news, watch the markets, and look at the fundamentals.
Is there a point, do you think EM ends the year maintaining its outperformance?
I do. I think EM is so undervalued when you think about, and not EM broadly. I think EM is an asset class that is not as efficient as the U.S. large cap space. So I think you have to be thoughtful about which countries you're investing in and which companies that you're investing in. As you do really in any asset class or sub-asset class, but especially in less efficient asset classes, there's a real need for active management and fundamental bottoms-up analysis when you're investing.
What are you telling your clients right now about exposure to AI disruption? The fact that, it's been painful. If you're in a lot of these software names, which were so popular and dominated the last few years of the tech space.
Well, we've talked about that together a lot. It's the concentration in the U.S. large cap equity market and how that was really a risky position. AI, I'm comparing it to the Industrial Revolution, and it's going to create a lot of disruption, a lot of change, but also a lot of opportunity. It is not going to render the software industry bankrupt. There will be winners and there will be losers. And like we talked about last time I was here, it's very important to be invested in software companies that provide holistic solutions as opposed to one solution. Because if you're a one solution provider, AI could replace that need, and then you're toast. Whereas if you are fully integrated into your client's software needs, replacing one component of that will not be dire for your overall business plan. But look, AI is causing a lot of the fear and volatility that we're experiencing, along with geopolitics and oil prices. It's just a very uncertain time to be an investor.
I was just going to say, sort of related to that, these concerns about private credit, this is not what they needed, right? what's happening overseas.
Well, except it's taking the AI software private credit concern off the front page of the newspaper and maybe moving it to page 4 or page 5. But yeah, there's a lot of concerns. Is AI going to replace the need for software, and how much exposure do these private credit funds have to these software companies that are at risk of becoming extinct? So that's the question. And as always, I would say it is critical to invest in top-tier private equity and private debt managers who have real risk metrics and due diligence into each of their underlying securities.
Anything that we need to know that your clients are asking around tax changes, just with the One Big Beautiful Bill, the midterm elections coming up?
I think there's still a lot of uncertainty. Uncertainty and duration, I think, are the theme today. The market is wrought with uncertainty, and I think the duration of this conflict is front and center. The midterm elections, we still have a bunch of time. Affordability is going to be key. Higher prices at the pump is going to factor into that affordability. You think about a $10 increase in oil equates to a 25-cent increase at the pump. So consumers going to fill up their cars, they're going to feel that. Industries that are dependent on oil and gas, travel, cruise ship operators, they're going to be suffering right now. But like I said, it could end as soon as it starts, and we just don't know.
No. So just hang tight.
Hang tight, have faith in your asset allocation, watch the news, and I don't know, I think in times of uncertainty is when your viewers and my clients listen the most.
Well, we're lucky to have you then at this time. As always, Holly, thank you.
Thank you.
Croft of Neuberger.
Still to come this hour, how the war in Iran might impact airlines and plane production. Jet fuel prices might have a ripple effect through the industry. The head of Airbus North America is going to join us next.
Plus, the market trend, one strategist says, could signal a shift from an inflation trade to a recession trade. We're back in a moment with that.
Welcome back. Airbus with plans to expand its U.S. production footprint, but this war in Iran and a surge in jet fuel prices could impact that. Our Phil LeBeau's in San Diego with more on that story. Hey, Phil.
Good morning, Carl. Robin Hayes, CEO of Airbus North America,
Hello,
joining
Phil.
us here at the ISTAT conference in San Diego.
Here we are.
We'll talk about production for Airbus in North America in just a little bit, but first let's talk about the Middle East, this conflict, what we're seeing with jet fuel prices. How worried are you about the surge in prices we're seeing right now?
Well, look, Phil, we've seen this before. You know, airlines are incredibly resilient. They go through many shocks, many geopolitical shocks. Oil prices is a normal, higher oil prices is a normal reoccurrence to that. We saw that with when the Russia-Ukraine war started a few years ago. And you know, right now, airlines will be very much focused on their networks, their people, making sure they're safe, their assets are safe, and also mitigating in the short term what they can do about higher oil.
When you ran JetBlue, you went through more than a few crises like this where jet fuel prices would spike. At what point do the airlines have to make a decision about potentially grounding aircraft? Is it really about demand at this point? Give us some perspective of what an airline executive committee is looking at right now.
Well, it's true that you go through this type of event a lot, but every event is a little bit different. And I think coming into this, you know, we'd seen pretty low oil prices for a while. We have seen a lot of new supply come on. We've seen more supply out of Venezuela as of late as well. So I think the fundamentals are point to a continued sort of moderation of oil prices. So that will definitely be in the back of airlines' minds. So it then becomes, how long are we going to be in this elevated situation for, and when do we need to start taking some action around that? If airlines think it's going to be a short, sharp event, they'll probably look to sort of just, if you like, get through it. If they think higher oil is here to stay, you're going to start seeing things like, you know, potentially higher prices, you know, some capacity, but it's coming out. But it's too early at this point.
It's still too early.
Still too early. We're 8 days, 9 days into this event.
For Airbus North America, you are in the midst of expanding your production. Yet at the same time, you have issues with the supply of engines coming from Pratt & Whitney. How much is that slowing down what you plan to produce, or is it a case of production increases are going through, you're just going to have potentially to park a few aircraft before you can deliver them?
Well, we're still growing significantly. I mean, in the last year alone in the US, we've added about 20% to our employee base. That's our new 350 composite fuselage facility in North Carolina, Kingston, North Carolina, and the third line in Mobile, which, Phil, you were there to see it. So we're growing. You know, we are still growing. We'll be producing more airplanes this year than we did last year. There was some moderation in that outlook for next year because of challenges we've had with getting Pratt & Whitney engines, and that's something we continue to work through with Pratt.
Is that one of those existential long-term challenges that you're looking at, or do you feel more confident as you deal with Pratt and you guys have regular conversations about their ability to ramp up production?
Well, the supply chain has been a challenge really since COVID. And you know, it went from a very broad-based set of issues to a couple of issues. We've also seen some issues with interior cabin equipment too. But I think the issue is very focused. So of course, a lot of ongoing issues, conversations with Pratt & Whitney. They obviously still have a lot of airplanes around the world that are grounded with their airline customers that don't have engines. So a lot of issues that they're working through. But we have tremendous demand for our product. We have a record long-term order book that we want to fulfill. Our customers want us to fulfill it. So we need to work through this issue with Pratt.
Last question. Does 26 still become one of those breakthrough years for the industry that people were expecting back in January, or is it now maybe on pause?
No, look, I think if you're referring to what we're seeing at the moment in the Middle East, let's see what sort of long-term impact that has. I think if it's a pretty short event, I think the trends that we're seeing in the industry, look, the adage in this industry, Phil, as you know, for many decades, is the industry doubles every 20 years. And so there is no reason why we're not going to continue to see that.
Robin Hayes, CEO of Airbus North America. Ready to go talk to everybody on stage?
Let's go, Phil.
All right, we're headed inside, guys. We'll send it back to you.
Okay, thank you, Phil. Phil LeBeau. Time now for a news update. Pippa Stevens has it for us. Pippa.
Hey, Sarah. New York Police Commissioner Jessica Tisch said this morning that 2 improvised explosive devices deployed during a protest outside Mayor Zoran Mamdani's residence at Gracie Mansion on Saturday were an ISIS-inspired act of terrorism. 2 arrests were made, and criminal complaints are expected later today. Bomb technicians rendered both devices safe, and no injuries were reported. Shots were fired outside the home of pop star Rihanna in Los Angeles Sunday. No one was injured, but LAPD says a woman drove up to the house Rihanna shares with A$AP Rocky, then fired 7 to 9 shots from an assault rifle, with at least 4 bullets hitting the house. According to police, Rihanna was home at the time. The suspect was taken into custody. And several Democratic senators set to introduce a bill on Capitol Hill today to extend the amount of time prosecutors have to file foreign bribery charges from 5 years to 10. The senators say the bill is a response to a Justice Department decision to pare back enforcement of the Foreign Corrupt Practices Act, a 1977 law that outlaws companies in the U.S. from bribing foreign officials. Carl?
Stevens, when we come back, the market trend that might signal fears are turning from inflation to recession as we're at session highs here, back above 6,700. Back in a minute. Welcome back to Money Movers. Our next guest warning quote: once bonds start rallying with oil, you'll know it's turning from an inflation trade to a recession trade. Joining us this morning is the co-founder of 314 Research, Warren Pies. Warren, great to have you as always. Thanks for the time today.
Thanks for having me on.
So we haven't really gotten to that pivot yet, have we?
No, I mean, I think the initial stages of this crisis, there's been a bit of disbelief in the market. I mean, it's probably rational, but everything is basically priced for a quick pivot here. And that includes the bond market. So, I think that the initial read was that, inflation, the Iran war is going to boost oil prices a little bit, which lowers the scope of the Fed to cut rates. But I mean, oil is my background. And if we run this experiment out, if we don't have a response here, which I think we will, so I don't want to engender panic, but if we didn't, 10 million barrels a day missing, you need to have prices go to a level that starts to kill demand and ration that. And that's recessionary. If we get to that point, I think the first tell that we're getting to that point in the economy will be yields starting to come down, bonds rallying as money gets replaced to hide, and it's no longer a read that the Fed can't cut as much. It's more of how much will the Fed have to cut to come to the rescue of what's happening in the economy.
Right. You do think that we'll reach some pain threshold, I don't know if it's in the markets or what, but that the administration will lean into some efforts. SPR, G7's not there yet. Do you think we get there?
Yeah, I think that truthfully, this is a physical. I heard things over the weekend. We're going to sell futures to try to manipulate the price. And my response to all that from last week when we were talking to clients and all through the weekend is that this is a physical problem. You can't solve a physical market problem with a paper solution. And so it's really pretty simple. There are three ways you can not solve, but you can extend the timeline, the ticking timeline that's working against us right now. Number one would be, I think, a coordinated release of global SPR. And number two, I think you need to see, a true ceasefire would be another thing. And then the third way to delay this, and I don't think it's really politically palatable, is to have military escorts through the Strait of Hormuz to make sure that we put these flows back. And so I think there are two temporary solutions, which is adding SPR to the market and military escorts. Then there's one permanent, and that's that we declare we have a peace agreement and move away from this conflict.
I will just note, as the markets come back, oil prices have come well off the highs as well. Crude oil now is up only 6%, and Brent only 6.5%. It was up double that amount earlier this morning, Warren, and treasuries are now rallying a little bit. I guess the point that's hard to figure out is, given we came into this year on a pretty solid economic footing, expecting these tax refunds and also lower gas prices, at what point does the calculus change where it really becomes a problem for the consumer and for the overall economy? Because we had a lot of tailwinds going in.
Yeah, I mean, if you told me how long this was going to last, then I could give you like an answer of how everything should be priced. But that's what we're all trying to balance right now. It's oddly familiar similar to last year, the tariff drama and Liberation Day. And I think there were a lot of people who learned this lesson, like, hey, don't sell the whole. And panic, Trump's going to have your back. Now, I still think that's probably the way out here. But if this thing goes 2 weeks, I'd say, without I'll put it even more finer point.
Beautiful engulfing here.
The signal that the administration and globally
at this clear area of resistance.
Really worried about trying to get that flows back through the Strait of Hormuz. Then you're going to see, in my opinion, outright panic.
Bearish reversal signal.
And so that will be a pretty quick test of investor resolve. And so I think by the end of this week, you need to start seeing policymakers respond. And then there's people talking about this summer. There's no way the economy will make it through that. I think that the most you could have is if we do a combination of those solutions I laid out, SPR releases, some kind of military intervention in the Strait. The next thing you know, you could have 4 weeks, 3 to 4 weeks to solve this, wrap the conflict up. But that's it. After that, I think you start talking about killing the consumer, all those good things you're talking about coming into the year. They're not going to be able to fight against what if we had like $7, $8 gasoline at the pump or $10 diesel, which is where you probably need to go in order to kill.
And until we get to that point, Warren, that's why the market's treating it as an inflationary event, not an economic event, where it's higher treasury yields, more inflation risk, fewer Fed cuts.
Yeah, absolutely. So like $100, $120 oil, like truthfully, we can live with it. It does take away some of the consumer surplus that we've been living with and the oil dividend and things like that. And yeah, the Fed might not be able to cut as much. So, but I think you can live with that. But that's not where we're going if this problem isn't resolved. And that's why I think there's a big disconnect between people who understand the oil market and then generalists right now. Because if you understand the oil market, you understand all of these things take time. If you shut in production in the Middle East, if you decide to release barrels from the SPR, especially in the United States, these things take time. And so we're up against the clock here. And if we don't hit the window that's open to start pulling some of those policy levers, then what's going to happen is prices go to levels that ration demand. So right now, yeah, we're worried about inflation, we're worried about the Fed. But the next thing you know, we're going to be talking about global export bans and things like that to try to save and ration energy at each country. This could get ugly quickly. So that's the next step. Yeah.
And on a retail gas level, really quick, Warren, the price that you think would destroy that kind of demand are prices per gallon that we don't really see in this country, at least.
Yeah, 10% of global demand. That's 10 million barrels a day is what the flow that's been cut off. And so that's where prices have to go to kill that. And it's kind of a ridiculous thing, but yeah, like $8 gasoline, $10 diesel fuel, that's what we're doing. Now it's like the equivalent of $350 to $400 crude oil or per barrel of those refined products. I mean, crude oil could be trading at, I don't know, 200 or 150, it doesn't matter. But those refined products, that's what's going to kill demand because that's what the economy runs off of. Now, that's not my base case. I would sure think that it's political suicide going into a midterm year to let this thing run and be that cavalier about the prices. But if we run the math and we say we need to kill 10,
beautiful reversal taking place right now. Beautiful
reversal. That's why it's, sooner rather than later it would be better for the markets.
Yeah. Warren, appreciate it as always. Good to chat. Warren Pies.
Still ahead, McKinsey with a new look at how CEOs are handling geopolitical turmoil. We'll get into that with the head of McKinsey in 2 minutes. Welcome back to Money Movers. The McKinsey Global Institute out with a new report today, diving into America's competitive edge. One area of focus there is, of course, energy. The report says, quote, reliable and affordable energy has been an enduring source of strategic advantage for the United States. The developments in the Middle East and the massive move in the price of oil, of course, calling into question America's growth outlook as CEOs try to make sense of what the geopolitical turmoil means for business. Joining us here at Post 9, McKinsey & Company, Senior Partner and Chair of North America, Eric Kutcher. Eric, welcome. It's good to have you.
Thank you for having me. It's great to be here.
So you do advisory services and consulting on all sorts of issues. Geopolitics, one of them. What are you telling CEOs and what are you hearing from them at this moment?
I think our CEOs are more resilient than they've ever been. They've lived through over the last 5 or 6 years, I would argue, event after event after event. And as a result, what they have learned to do is manage through the moment as opposed to the moment. And so I see very few CEOs that get too ruffled by what they see in the headlines as to what it's going to do today. But they look out and they say, where do I have to get to over the next 3, 4, 5 years? And how do I make sure I'm still kind of aiming the ship towards that, no pun intended. And so I am not, the geopolitics of this particular moment, I'm not seeing any more than what I've seen over the last several years. And I think that's going to continue to be the way. And
then from the report, the fact that the U.S. is such a major producer of oil and energy, it does change the game.
Yeah, I mean, we're self-sufficient if we need to be, right? Which is not where we were pre-2019. And so I do think we have the energy independence if that's what we need. And I think that does make a difference how people think about it. But obviously, everything we're talking about is a very global market. And so the price does have impact.
I am curious what's happening with your own business because there's been a pretty strong narrative around the AI disruption trade. Software is in the firing line. I mean, every day it's something different. I know McKinsey's not a public company, but there are those out there that say a lot of what you do, the consulting services, are going to be able to be done by AI.
Yeah, I'm more optimistic about the next 10 years than I've been in a very long time. I think the AI moment, which I continue to refer to as the reimagined moment, is an opportunity where every organization has to think about how would I build an AI first version of myself and really disrupt myself. And in that moment, more and more of them come to us. And so I have more conversations with CEOs about this moment. I have more conversations that are leading towards opportunities to how do I transform. One of the things we talk about is this is a 80% business transformation and 20% tech. And in that world, that's what we do. And we've spent the last 10 or 15 years really pivoting what we do away from what I would call insight into actual impact. And so
what's an example of that?
We partner with a client to figure out how to drive $1 billion of incremental sales over the course of the next 18 months. And we don't work with them just on where do you set the strategy, but how do you actually do all the change management that gets you there. And we ultimately get paid based on whether or not they're successful, not based on whether we deliver a report. And in this moment, that is perfect for what every one of these organizations is going through.
So the trend is more to outcome-based?
For sure.
Work?
For sure. I mean, I think it's now, it's more than a third of what we do.
One thing that was written this morning was sort of like we mentioned the oil markets, that there's been like this lack of humility in the last few years. You didn't think oil could go negative, it did. You didn't think Russia would be an unreliable partner, it was. Now you thought the Strait was too important to block, it wasn't. And I wonder if you're writing more tail risk reports, a wider spectrum of possibilities, that kind of thing.
For sure, we have a sizable geopolitical practice, and a big part of this is to think about what are those things that you don't see. It's somewhat easy to figure out what you do for the things that you know are possible. It's the things that you don't know that are possible, right? I don't think anyone could have imagined COVID actually happening. And so you start to think about how do I manage through those moments. But as I said earlier, most executives are pretty, I would say, battle ready, right? And so they've kind of learned how to deal with these things.
That's one argument that some make to say that the current generation of CEOs may be the best ever because they've lived through so much.
So much, and it used to be you never thought you could live through more than one crisis or manage the one more. And any given day you might have 2 or 3 that you're dealing with, and these executives have learned how to manage that.
I like the report because I think it's a good, strong, bullish case for America.
It's optimistic.
It's totally optimistic. We have the best firms and the biggest firms and the most productive firms. I guess the question, Eric, is do you compare it with China? I mean, what are, as you think about American competitiveness going forward, where are the biggest threats and the biggest competition?
Yeah, I think it's hard to bet against the United States. right? Time and time again, as people have done that, I don't think that has been a good bet. I think Warren Buffett has said, bet on the U.S. all day long, and I think that's a little bit what this report says. And it's not the first time we faced, if you will, competition and significant competition. Go back to the race to the moon. I mean, we've had these moments in the past. I think in this particular case, we have all the endowments, right? And we have, I think, the most innovation. We have nearly the greatest scale. And I say nearly because China is actually larger on some dimensions. And the question is whether or not we can overcome some things that have historically been these endowments that are now deficits, right? You could look at the amount of debt that we have today and say, is that a problem as we look to the ability to attract the investment that we have going forward? You could look at our infrastructure, which was absolutely world class, is now really falling behind. I think the latest data I saw says $7 trillion is what you need to believe you could spend to really get our infrastructure back. And in this particular moment where you could argue we're moving to an economy that is based on purely electrons, when you think about this AI moment, do we have the energy that we need? Do we have the grids that we need? And how do we get there, and do we believe we can? And I would argue other things that we have to overcome is education system, simple math. Right? China literally graduates 10 times the number of engineers that we do. Right? How do we overcome those in a world where
these are all challenges.
These are all real challenges, but I am pretty optimistic that we can and we will.
Yeah, or the job disruption too. We had Gina Raimondo on talking about how that's something that they're going to have to figure out that comes with AI.
Yeah, I am more bullish that we're not going to see that disruption. I know this comes up, and I know it certainly comes up in the context of last week's job report. I don't think that had anything to do with AI. I really don't think. I think there's not a single CEO that I have seen so far that will tell you they have gotten real productivity out of AI. And more of them think about the productivity more in the terms of what can I do from a growth? How do I start to think about reallocation of resource? And so you can think about the productivity on two dimensions. I can think about cost, or I can think about growth. And very few get excited about the cost side of it. Most start to think about, what am I going to do? And I had one CEO say to me last week, I wish I could go get another 1,000 sales reps. Right? And if I now have the ability to afford myself to do that, I will grow my way into that. And so it's just an interesting view that I think I see a lot from them.
Yeah, that's a real pushback on some of the doomsday.
I am much less
stuff.
doomsday.
Yes, we got Eric. It's great to have you.
Thank you for having me.
It's good to have you in town. Eric Kutcher from McKinsey.
When we come back, how AI companies are valuing the lifespans of their chips. Oracle and NVIDIA at the center of that story, the impact on the broader AI trade when we come right back. Shares of Oracle down about 2% today after reports that OpenAI won't be expanding its data center deal with the company. OpenAI executives posting that they're instead choosing to put additional capacity into other locations. Our Deirdre Bosa has more on that in today's Tech Check. Hey, Dee.
Hey, good morning, Carl. So there was a lot of back and forth over the weekend, but the takeaway is this. The chip cycle is moving so fast that even the biggest infrastructure deals can't keep up, and Oracle is where that is hitting hardest. Now, the information reports that OpenAI walked away from expanding that flagship Stargate data center in Texas because power won't be ready for at least a year. And by then, OpenAI does not want the current generation Blackwell chips because NVIDIA's next gen Vera Rubin will be available. So this suggests that they'd rather build a new site with newer hardware. Now think about what that means for Oracle. It committed the debt, it secured the site, it ordered the hardware, and now the customer is saying, by the time you're ready, your chips are dated, and I'd rather go somewhere else. Now, Oracle cannot afford that. It doesn't have the cushion that the other mega caps have. Google, Amazon, Microsoft, they're also spending big on AI, but they're funding it with cash from enormous profitable businesses. If a site goes sideways, they can absorb it. But Oracle is sitting on more than $100 billion in debt on the books. Free cash flow has already gone negative, and they're reportedly cutting 30,000 jobs just to free up some more cash. So its leverage does not leave room for its biggest customer to move on. And the pitch to a replacement isn't great either. Come lease the chips our last customer didn't want. Now, for the AI trade at large, the environment is becoming even more difficult. Borrowing costs are rising, markets are volatile, of course, and Oracle's own financing partner, Blue Owl, is pulling back. Now, one of the mega deals this whole build-out depends on just cracked in public because the technology is moving faster than the deals that were built around it. So, guys, Oracle may be the canary in the coal mine. We knew that, but this is another really important piece of data. The company reports tomorrow night, and that will certainly be required listening for investors.
The other thing, Dee, this piece this morning about SoftBank, CDS, it's all tied together.
Absolutely.
Masa, and what Masa might be thinking at this moment.
Yeah, and all of it sort of sums up to pressure on this AI build-out, something that the markets have been looking at for months now, but we're starting to get more and more concrete evidence of that.
Okay, Deirdre. Thank you, Deirdre Bosa. We'll look for those Oracle earnings. In the meantime, I mean, it has been a pretty nice comeback for the market. Oil certainly well off the highs. It's still sharply higher this morning, but we're back below $100 a barrel, both on Brent and WTI. Treasuries have turned around too. They're sort of unchanged right now, but look at the S&P 500 down 0.5% and the Dow down only 0.8%. We've got groups like Staples popping into the green, joining energy and technology. Some of the AI names like a Broadcom working today.
Yeah, week is really just getting started. Let's get to Frank Holland in for the judge.
Thank you, Carl and Sarah. Welcome to the Halftime Report. I am Frank Holland in for Scott Wapner. Front and center at this hour, the big comeback. The Nasdaq just on the brink of going green following some steep losses at the opening. All the major averages, they're well off their lows as oil pulls back from a near 4-year high. Our investment committee standing by here to break down this entire turnaround and much more. Joining me for this hour, we have Joe Terranova, Steve Weiss, and Jim Lebenthal. But first, quick check on the markets right now. You can see we are in the red across the board, but as we mentioned, the Nasdaq just fractionally away from being flat. The Dow down just about 430 points. The S&P pulling back about 0.5%. You can see oil up over 5.5%, but well below $100 a barrel. Right now trading at just about $96 a barrel. And I think that's where we have to start, Joe. The impact that the rise of oil prices have had on the broader economy. I have to include in there also diesel prices here in the U.S. We're going to talk more about that. Really the fuel for transportation here in the U.S., raising the cost of shipping. But in general, consumer confidence falling on these rising oil and gas prices. What do you do today on this Monday with so many questions about Iran and the path forward?
That's a great question. Look, I think markets have a rhythm for their movement, and I think 2026 you could define the rhythm of the market as a roller coaster. It feels as though each day it's exactly that. You get on the roller coaster and you basically get off in the same spot. The operator of the roller coaster right now appears to be the price of crude oil, and wherever the crude oil market is going to go takes where the overall market is. There's resiliency in the market for sure. I continue to say if you have a hyper volatile environment where it is resembling a roller coaster, just this ride basically back to where you began, in that scenario, what do you want to do when everything looks really, really good? You probably take the other side of that. When everything looks really bad, you take the other side of that as well. But as it relates to crude oil, at the end of February, the average volume for spot crude oil was 300 contracts per day. We're now running close to 1 million contracts per day being traded in spot crude oil. So look, that tells me I understand the fundamental concerns that speculators might have, but that's beginning to feel a little bit like silver 1 month ago, where we're beginning to see some of the excessive speculation take hold within the marketplace. Take comfort in two things. Last point. Number one, we are seeing that the Mag 7, in particular, the NVIDIA, the Alphabet, the Apple, they're doing what they're supposed to do. They're being perceived as quality, a port in the storm. And then I think you have to look at the fixed income market and see the incredibly calm environment. So far, year to date for a 10-year Treasury, you're talking about only 38 basis points with a range. Fixed income trading really well.
You know, you mentioned the word resilient, or resilience, I should say. Some people are also saying complacency. I'm looking at the S&P about 4% away from its all-time high. The NASDAQ 100 about, 6% away from its all-time high. Steve Weiss, are investors, and Joe just mentioned the bond market, are they complacent or are they resilient in this situation? The fact that we might even see the NASDAQ turn green during this show.
Well, you know, it's an interesting question. By the way, I think I'm tired of the word resilience. Everybody uses it for everything. Investors resilient, retail's resilient.
What's a better word?
Resilient. There is no word for it because it really doesn't come into play. Markets go up 90% of the time. Anytime you sold during geopolitical risk, or anytime you sold, period, right, over the last few years and stayed out, you know, the market's higher. So in terms of complacency, that makes you're essentially making the judgment that there are real issues there that the investor is ignoring. And the truth of the matter is we don't know. So if you go back to how everybody was looking at this year, not just me, but you and everybody, volatility, right? Now, nobody expected this kind of volatility. This is volatility on steroids. And you can look at volatility, you look at it one of three ways. Okay, retail investors tend to look at it as risk, right? Others, I think, you know, hedge fund managers, professional managers look at it as opportunity, right? Displacement, either to get out of shares. And volatility cuts both ways. Goes up, right? There's volatility higher, volatility lower. And then you can look at it as a nuisance. I think in this market, it's a nuisance for now. However, if you ask me what I'm concerned about, and I mentioned this on Friday, I am concerned about stagflation. We're seeing jobs growth negative. We're seeing inflation hold before this higher than what the Fed was looking at. So when you have inflation moving higher and the economy moving lower, right, that's stagflation. Now the question is, how long will that last, and are we actually in it? We don't know. Everything at this point depends on the duration of the war. Trump could come out any day, any moment and say, hey, victory, right? And we'd all go home, market would go up. And you still won't see the impact of the problems until later on. So the point of all this, my conclusion is that you hold where you are now. Anytime, as I mentioned again last week, you tried to catch a falling knife, you know, you made a mistake. You got cut hands instead of buying values. So I think you can wait, right, to put money to work. Having said that, depending upon your time frame, depending upon what you're buying, right, you can hold it, except for things that I still think were very overvalued going into this. They're still overvalued.
Are you lumping software in that group? Are you
software? I bought Microsoft.
Discount retailers in that group, because a lot of things are falling that I don't think people thought were overvalued until this happened. The rise of oil prices changes the math.
That's not true in software. That's not true in software.
No, I'm asking, are you counting software? But discount retailers, I didn't hear anybody.
But not because
nobody said those were overvalued until this happened, and now all of a sudden we're seeing calls for those to sell low.
That's not true. Plenty of people said software's overvalued.
No, I said discount retailers. I'm saying there's different parts of the market. Yeah.
Discount retailers, you just don't know. You don't know how this is going to perform. Okay. Look, most of the, two-thirds of the country lives paycheck to paycheck. So now with fuel prices going up, how they've gone, I mean, same grace, we've got warm weather across the country, right? So less heating costs for this time of year. But now they've got to put gas in their tank. They've got to put energy into their home. So discount retailers, they're going to have a tough time.
All right. You don't like resilient. What about constructive? Jim, I'm going to come over to you. Mike Wilson from Morgan Stanley out with a note saying in part, I'm just kind of summarizing part of it, we think we're closer to the end of this rolling correction than the beginning, talking about the falling knife that Weiss was just mentioning. And Morgan Stanley remains constructive over the next 6 to 12 months, speaking of a time frame. Agree or disagree with that take?
I can't agree or disagree on it because it requires some prediction of when the war is going to end, and that's not knowable. That's not something that you can do a degree of analysis and come up with when the Straits of Hormuz are going to open to tanker traffic again. However, that is the key point. That is the pivot point upon which the markets hang right now. When you start to see tankers other than Iranian flagged or Iranian associated tankers transiting the Straits of Hormuz, that's when you'll see oil come down and you'll see the markets rally with it. The weakness in the market, and as much as I'm happy to see that there's been an intraday rally, I'm not sure I trust it because the markets just don't know how long this oil spike is going to last, and it will do damage. The good news here, Frank, is before it does damage, there are cushions both in the economy and the financial markets, whether it's growth in GDP, whether it's the fact that inflation had been coming down, profit growth, stimulus from the budget bill, a number of cushions, but we see those cushions being eaten into, for instance, with Friday's labor reports. The point of this being is that the longer this goes on, the more damage will be done, and frankly, there isn't that much time left until we get the Straits of Hormuz opened if we want to avoid damage. The president says this is a 3 to 4 week operation. Okay, if that's the case, maybe we'll skate through without lasting damage, but frankly, I think the markets want to see tankers transiting the Straits of Hormuz this week. I'm going to keep my disciplined, diversified portfolio. I'm not panic selling here at all, but I am keenly awaiting news of tankers transiting the Straits.
But it's not just when the Straits open. It's if there's more damage done to the oil production facilities in Saudi Arabia, throughout the Middle East. That's part of the issue.
You know, I want to refer to something our Brian Sullivan has said because he's coming up in just a second. He said it's not just about getting the oil out. It's if other ships feel safe enough to go back in and just keep the supply chain going. So speaking of Brian, for much more on the turnaround in oil, I want to bring in our Brian Sullivan. Brian, we're looking at oil move lower. We're also looking at the NASDAQ right now, Brian. Very close to at least flat, possibly turning green. Looking at oil WTI at least, trading about 96.60 a barrel. What's the very latest?
Well, we got some breaking news on CNBC.com, which I think goes exactly to your conversation about the Strait of Hormuz. And if I'm right, this could bring oil down even more. I'd love to get the former oil trader Joe Terranova's view on this. But the Iranian Foreign Ministry is saying, and I'm not sure where they're saying this, it's up on CNBC.com right now, that any tanker transiting the Strait of Hormuz, quote, must be very careful. Now, interesting language, because if you read into that, and again, love Joe, the former trader's take on this, if you read that, must be very careful is not we're going to blow you out of the water. It's you cannot pass the Strait of Hormuz. It is not we're going to send missiles your way. Must be very careful. To me, and I'd love to hear everybody's view, to me, that feels like, that sounds like a slight de-escalation. You can see the live map there, Strait of Hormuz right at the top of your screen. A lot of ships at anchor on the right, kind of waiting to get in. A lot of ships at anchor on the left, waiting to get out. Nobody's kind of in the middle, but we'll see if those words, must be very careful, make it a little more amenable for some ships. Now, guys, we have had, I want to be clear, this whole, the Strait of Hormuz is closed. I don't like that word. Great job, guys. It's not, nothing's closed. There's no gate on this. You can make it risky. Plenty of Iranian and Chinese flagged or cargoed vessels are getting through because they're not going to blow up basically their own ships or their own oil. But I do wonder, and let's see what happens with the price of oil. And then the point I was going to make, guys, is this. And if you look out, we always show the front month contract, the April contract. That's the one that's up on the screen. But if you look out, there's other contracts, May, June, July. Look at that. I say it and it happens. And you can see the price. And if you're on the radio, 96.47 for the front month for April. And you got 92.5, 86, and then basically just under 82. That's indicating A, the market expects, it may be wrong, but it expects things to calm down. But also, I think it goes, Joe, to the extreme options positioning that we had in the market. You'd mentioned at the top of the show how, it's 3 million or whatever contracts. A lot of those were net short, which means when we got the escalation last night, everybody had to cover. They got their faces ripped off. And that's why we saw the price of oil have the biggest intraday spike percentage-wise in the history of oil, 35% gain. And it's also why oil's come down, because you've got those people they've covered. And now the market, I think, the positioning is going back to normal. But I'm watching. These headlines coming straight off the Iranian Foreign Ministry feels like a de-escalation.
All right, our Brian Sullivan at CNBC headquarters. To your point, Brian, we're looking at those forward contracts. Certainly, it seems like the market is pricing a de-escalation. We'll have to wait and see. Brian Sullivan, thank you again. Joe, he called the shot. Former oil trader, you and I were talking about this before the show, the fact that you made, your bones in the oil market. What is your view of some of the things that Brian's talking about, the short covering, and just also this sense that the market seems to see some type of de-escalation coming up?
Well, I guess I didn't make enough bones because I'm sitting here with all of you, but I tried my best to do it. And understanding the market, when you look out on the curve, what you see right now is significant backwardation. And this morning I was looking at the curve and observing where we are in terms of the price gains months to date. So spot, you're up about 50%. You move out into the June and July contracts, you're up about 30 to 35%. Where I think the expectation that ultimately this conflict resolves itself is when you move into the fall. Those contracts month to date, they're only up mid-teens at best. So it looks like the market is expecting that you can have simmering tensions even as we move through the summer. They tend to alleviate those tensions as you move into the fall. To Brian's opening remarks surrounding the comments from Iran, look, protecting oil assets, I believe, is in everyone's best interest, including Iran. It would be sabotage for them to do something where the response would be to destroy or to impair their oil infrastructure. That's their economic lifeline. So whether it's the U.S., whether it's China, whether it's India, whether it's assets in the Middle East and the interests of everyone, I think the expectation is that you're going to protect these oil assets. And I do think right now, as I said at the top of the show, I do think you have to build in some excessive speculation into the market right now as far as what's unfolding. Again, it has that feel to me as precious metals did 1 month ago.
The only one that wants a straight close is Russia. Let's be clear about that, right? Because they want Russian oil to go out more in the market. China, obviously, I would say obviously, I don't know this for sure, but China has to be in Iran's ear. They've been a big benefactor of Iran, and they're not getting their oil, and that's where they get most of it from. So they want to flow through the strait. So they say be careful. I think it's a real leap of faith to try and parse what the Iranians mean by what they say or take it on face value. That's a big mistake, as we've seen.
In a developing situation, especially.
Right, in a developing situation. So I think the trade down in the price is from speculation and nerves that drove it over 100.
Speaking of headlines, Brian hit on one of the headlines to go carefully through the strait. Also, Reuters out with the headline saying the president is expected to review options to look at oil prices. He's very concerned, according to this report, and people familiar with the impact on consumers and businesses, especially ahead of the midterm elections. So not groundbreaking news there, but again, reports saying the president's going to look into it. At the same time, Joe, you made some moves in the oil market. You're buying a Brazilian oil company and a Canadian oil company. Walk us through those moves.
Just being tactical. So year to date, I've been tactical in trying to build positions in the energy market ahead of all of this. One of the trades that I put on, and it's a trade, it's short term in its nature, so it's running Jimmy somewhere around 90 days, and that's the OIH. I've moved out of the OIH. I think I collected somewhere around 18%. I've taken positions utilizing those funds in Canadian natural resources and in Petrobras. The reason being is sourcing comfortably, securely their oil. Seems as though that will be something that's in front of us here in the coming weeks. You're seeing both of these stocks do really well since this unfolded. The OIH, the service names, they seem to be struggling right now. So again, it's tactical more than anything else, and that's what I'm attempting to do with energy.
All right. While we're looking at the energy market, we got to talk about the broader impact. Jim, I want to come over to you. Dr. Ed Yardeni raising his recession odds from 20% up to 35%, due in part to the oil shock. When you're looking at the markets, what do you see the broader impact being after today? We are seeing oil prices ease back a bit, but certainly still elevated.
Well, look, I'm no fan of parsing the words the way Brian was. I'm not calling him out. I think you know, number one, you have to be able to speak Farsi to understand what the language content really means, and you have to be inside the inner circle in Tehran, which none of us are. And where I'm going with this is, again, this just depends on how long this lasts. You're seeing in the market right now rational responses in the form of hyper hyper discretionary stocks selling off, whether that's travel, leisure, entertainment, those sorts of things. Now, they can snap back very quickly if we in some way declare victory and move on over the course of the next week. But if we get to the end of March and we're still bombing Tehran and we're still talking about whether it's Iranian or Chinese or other countries' tankers that are transiting the Persian Gulf, the effects are going to be a little bit more long-lasting. You're going to see it not just in consumer confidence, which I worry about, but you're going to see it in profit margins, which I mentioned earlier. And this can take the form of anything. It can be higher fertilizer costs because natural gas prices are higher, which in turn is going to raise food prices. I mean, the effects of a prolonged inflated energy complex, the longer this goes on, is going to be pretty pronounced. Now, I want to go back to where I was a minute ago. I'm not selling here. I'm not giving up on a diversified portfolio and going to consumer staples or something like that, because I do think, first off, I have a lot of faith, a lot of respect in the U.S. military, and I think there's a reasonable chance that in short order we will get this situation solved, but I don't know, and nor does anybody else. So I am on a razor's edge that I may have to change my stance the longer this goes on.
I think the biggest comfort for the market right now is when you talk about the economy and the cushion it has, is what I said at the top of the show. It's where rates are. And the fact that rates have not really spiked aggressively, that's going to be incredibly problematic for the administration, for the Treasury, if we see a significant spike in yields concurrent with what the volatility is presenting in oil. And I think you have to be comforted that we haven't seen that yet.
Well, while you're on that, Joe,
very quickly, does that change the risk that might be for the market coming up with CPI in just 2 days? The fact that we could see a hotter than expected CPI?
Look, my personal opinion is what's going on right now, and even if the price of oil continues to move higher, I don't think that the response from the Federal Reserve to that should be, okay, we're going to raise rates, even if you see an inflationary spike.
Therein lies the problem.
I do not think
it is the Fed.
So there are people that are saying, okay, well, if we get the inflationary spike, you raise rates. I think the actual opposite. I think as oil goes higher, that's telling you probably need some more rate cuts.
Yeah, I would say rate cuts are backing out. Rate cuts are backing out. We're now down to maybe one, possibly more than that by the end of the year. First rate cut in July. And at the last meeting, they were actually talking about, some people were talking about raising rates. Now, before you get to raising rates, you have to back out the rate cuts. But this should not be off the table for anyone. And I will tell you, we got through 2000. Yeah, exactly. And yeah, Joe.
Really? It's off the table for me.
So you want to raise rates?
Hang on, guys. All three of you, just hang on. Okay,
okay, Jimmy.
Hang on. Just hang
Jim,
on.
calm down.
Okay. In 2022, you had an oil price spike. That wasn't what cratered the economy or the markets. It was the Fed raising rates. So we should be paying attention to that. We started this year talking about 2 to 3. Now we're down to maybe 1. I mean, you have to back out the rate cuts before you get to rate hikes, and they were talking about it at the last meeting.
Can you call on me?
Yeah, Joe, go ahead.
Let me just respond real quick.
Give him a second to get this
in 22, the Fed raises rates, and what happens? We go into an earnings recession. Do you want that again? Do you want them to raise rates?
No, that's why I'm saying be aware of it.
Okay, look. You never say never, but so I'm using that with some poetic license. There's no chance of the Fed raising rates. Not while jobs are going the other way, right? They're not going to do it. Period. End of story. They're not going to cut rates necessarily. Not only that, to them not raising rates. Okay, you can look at the tariff. We're gonna anniversary the new tariffs, the 15%. So that's really a temporary thing that's out of control. Out of control of the Fed in terms of it's not going to be demand driven, right? So they're putting tariffs on it. So I'm not worried about that.
Oil moving higher has a deflationary economic effect on the consumer. Agree?
Yeah, absolutely.
Let me be clear. This is not my base case. I'm simply saying we shouldn't dismiss it.
But Jim, in all fairness, you weren't unclear. I think we were just all shocked that you thought that we may need to raise rates.
Hey, listen, they talked about it at the last meeting. Like, that's a warning shot. I mean, just pay attention to this is all I'm saying.
Understood. I want to get on the market. Jim, while you're saying that there's potentially a need to raise rates, I want to talk just about the markets in general. Note out from JP Morgan's trade desk saying that they see the potential, at least, there's risk for the S&P to pull back to a correction level about 6270 from its all-time high. So about 10% from the all-time high, not from where we're at right now, but from the all-time high. Can Do you see potential in that happening? And could this CPI report, if other people see it the same way you do, is potentially a report that could lead to a rate hike? Does that have the potential to lead to that correction?
Yeah, again, base case is not rate hikes. I'm just saying we got to be aware of it. And as for a correction of 10%, that usually happens in a given year. You should expect it. I mean, we went into this year talking about midterm election years that the average drawdown is 19%. So 10% would be nothing. And by the way, when drawdowns happen, when corrections happen, there's always a reason. It doesn't just happen just because. There's a real reason, and this is a real reason. Now, I do think that the economy is strong enough to get through this, but as I've been saying, the longer it goes on, the more damage can be done.
I don't know. It feels to me like we've had that correction, but it's not in the overall market itself. It's underneath the surface. It's in the financials. It's in obviously a lot of the private equity names. It's in software. It feels to me we've experienced that already. What can probably avoid us having a headline S&P 500 10% correction is the strength that's being exhibited recently in the names like Alphabet, Apple, and NVIDIA.
One thing we have to address is the pullback in the VIX, still elevated at about 27, almost 28, but off of its highs of at least the open, where it was about 32. What do you make of this pullback? Is this simply reflexive when it comes to oil prices pulling back?
I think one of the reasons, Steve doesn't want me to use the word resiliency, but one of the reasons why when the market looks its worst, we recover is because there is a perceived hedge against the volatility, and that's the price of crude oil, and we're seeing far more activity there on the part of speculators, whether it's retail, I don't know that it is, I think it's more institutional, but you have that hedge against the volatility, and it's the spot price of oil.
Yeah, Weiss, I want to get your take on it. By the way, Wolf out with a note saying they see a notable spike in volatility ahead. They believe it's going to break through 30. Obviously, it already did, but they believe there's more upside when it comes to volatility.
There's more volatility is what they're saying?
Yes.
Yeah, I don't disagree with that. But again, volatility goes both ways. People tend to think of it, there's only downside volatility.
That's why I came to you. So,
right?
so if the volatility goes up, where do you put the money?
Look, as I said, we could see the president come out and declare victory, and I think that would be accurate to a certain extent. Any moment. It depends how much pain he's willing to tolerate in the polls, which have been painful going into Iran, and how much pressure he's getting from the party in advance of midterm elections and rising oil prices. In that case, I think you'd see a really big uptick in the market, a nice bounce. I don't know how long-lived that would be, but it would definitely bring back, the VIX. So I don't really focus on the VIX. I focus on companies. I don't focus on the technicals. I do look at them, but I take a look at where the corrections really hit the market. Take a look at a Goldman. I mean, Goldman, that's come down. That was on its way to breaking 1,000, and now we're down, and flirting with 800 on the downside. Anything changed for them? Not really. Okay. So that's where I am.
You got your NASDAQ higher.
You were looking at the NASDAQ right here, just fractionally higher right now, poking its head into green territory right now. By the way, Emily Wilkins down in Florida right now with GOP leaders in a retreat. So we'll have to see if anything comes out of that. To your point, Weiss and Joe, also about the president maybe changing his mind, maybe getting a push from his own party with the midterms coming up. All right, coming up next on Halftime, our top call of the day. One firm saying for the first time in 5 years, this beaten down sector, it's a buy. We're going to see if the desk agrees. More Halftime coming up in 2 minutes. Welcome back to the Halftime Report. It is time for our call of the day. It's on software. D.A. Davidson calling this space investable for the first time in 5 years. A lot of ownership here on the desk. Why don't we start with the name that's going to be reporting this week? It's Oracle. Jim and Joe, you both own this one. Joe, I'm going to start with you.
Okay, Jimmy, am I allowed to go?
I love you. Please
okay,
go
there
ahead.
you go. Earnings up 16%, revenue up about 14%. I think they really have to define business conditions for Oracle Cloud Infrastructure. They have to talk a lot about the businesses that are unrelated to the partnerships with Stargate and with OpenAI. They have to really detail that they are more than just that ultimate relationship. Now, am I confident? I'm comforted that they can get past all of that? Not necessarily sure. I think, though, when you look at software, Oracle is one of the names along with Palantir and Cadence Design, which we own in the ETF, that bottomed in early February and has been able to kind of, through the month of February, withstand some of the significant volatility that's been present in the market and not kind of break down further. I like Cadence, I like Palantir a little bit more than I like Oracle, but I do think you have that point of reference to look at and say, okay, maybe we've got some stability and the worst is past on some of these
Joe,
software
you're on the
names.
clock. You're starting to cut into Jimmy's time.
I'm sorry.
So
I apologize, Jim.
We got to keep it serious, guys. By the way, the names that the D.A. Davidson analysts like: Adobe, Microsoft, Palantir, and Oracle. Everybody owns Microsoft. Weiss, I'm going to come over to you. One of their points in this is they say that investors are basically misunderstanding the impact of AI, and that this put companies like these at an attractive valuation, again, to their point, for the first time in 5 years. Do you agree with that thesis when it comes to Microsoft?
Well, I've been adding to Microsoft. It's now a core position. The truth is you can't misunderstand what you don't know. So all you can do is make a bet. So D.A. Davidson has no idea the impact of AI on any company. But what you do is you assess where they are positioned and what you think they can do. Let's keep in mind that Microsoft was in front of it, as was Google and others, but Microsoft, their investments in OpenAI before anybody's really investing in them. So I'm making the bet that this is going to be good for Microsoft. I backtracked my position that they're going to benefit more than anybody else. But I believe they know what they're doing. Some of their core products, like their Office suite, definitely take some hits on it. But, you know, I'm there. I think it's cheap, cheaper than it's been in a long time. And I think that this one's been risk managed pretty well.
But you also liked it when it was higher, in all fairness, because you were adding to the position.
I did, but it wasn't a core position, and now it's a core position. So I've been adding to it a lot.
In general, if you look at the IGV, software is about 26% off of its 52-week high. I'm looking at Adobe, about 37% away from its 52-week high. Harder hit than a lot of other names. Jim, coming over to you.
Yeah, it has been hard hit. Sorry, I'm chuckling about it. But reports on Thursday. They've had very good reports for the last several quarters in a row, and it has had absolutely no positive effect on the stock, hence being down 37% from the high. However, now trading at about 12 times earnings, what I'm actually looking for here is how many shares did they buy back. Over the last 5 years, they've shrunk share count by 12%. I believe in the company. I ask rhetorically to everybody on the desk, to everybody watching, how many PDFs have you opened today? Don't answer, but it's a lot. Okay, the PDFs are not going away, but that's only one half of the story. All the bears are saying eventually they will, that AI will not only replace what Adobe does, but will kill all the jobs that are being paid for in Adobe's revenue stream on a per-seat license basis. Ultimately, I see this as a long-term winner, 12 times earnings. Let's look for how many shares they've bought back.
Yeah, I think the question really is about the Creative Cloud business, not that other part of the business with PDFs. But we'll have to wait and see, Jim. Looking at Adobe shares, down just about 1%. We want to turn to D.C. now. We're getting some news out of Washington. Let's get to our Eamon Javers with the very latest. Eamon.
Frank, that's right. I've just been on the phone with sources familiar with the G7 meeting this morning. That's been really the focus of attention in the oil markets today. And what these two sources tell me is that this meeting tomorrow with the energy ministers is going to be tomorrow in the morning. It's going to be a virtual meeting, not in person. And that is scheduled tomorrow morning, U.S. East Coast time. Sources also say that talks among the G7 are, quote, positive, unquote, in terms of the possibility of coordinated action in releasing reserve oil into the market. Any coordinated action on that would occur, of course, after that energy ministers meeting that's scheduled for tomorrow morning. The source is also confirming the U.S. stance on this, which is the U.S. believes that a joint release of 300 to 400 million barrels, representing 25 to 30% of the 1.2 billion total barrels in reserve, would be the appropriate amount. So the U.S. is asking here, or suggesting here, that a joint release among the G7 nations from their reserves of 300 to 400 million barrels, representing 25 to 30% of total reserves, would be the right move here. So a little bit of guidance heading into that meeting tomorrow. I know a lot of folks were watching that G7 meeting this morning and may be surprised that they didn't move jointly on releasing reserve oil. Well, I think the expectation is that this meeting tomorrow among the energy ministers will be the key decision point for that, and we'll see what happens. Frank?
All right. Eamon Javers live in D.C. with the very latest. Eamon, thank you very much. Time to get to the headlines now with our Julia Borston. Julia, good afternoon.
Frank, the Pentagon identified the 7th U.S. service member killed in the war with Iran as 26-year-old Army Sergeant Benjamin Pennington of Glendale, Kentucky. Pennington was seriously wounded during a March 1st Iranian strike at Prince Sultan Air Base in Saudi Arabia. Vice President J.D. Vance says his remains are expected to be returned to the U.S. later today. Uber announced it's expanding its women-only option nationwide. The feature allows women riders and drivers to be matched with other women. But an ongoing class action lawsuit filed by male drivers in California aims to halt it. They're arguing the feature discriminates against men and limits earning opportunities. And the White House said it fired National Transportation Safety Board member Todd Inman after receiving reports of inappropriate behavior and failure to attend meetings. A White House spokesperson told Reuters the allegations include inappropriate alcohol use on the job, harassment of staff, and misuse of government resources. Inman denies the allegations, calling it a political hit job. Back over to you.
All right, our Julia Borston with the very latest. Julia, thank you very much. Coming up next, we got your ETF Edge with Dom Chu. Dom, what's coming up?
All right, Frank, markets have been rotating away from tech and media and into so-called value parts of the market for months now. So has the recent turmoil in the Middle East exacerbated that trend or maybe even reversed it? We're going to chat with one investor who runs a sector rotation fund for what he's seeing. That's coming up next in ETF Edge on the Halftime Report. And welcome back to the Halftime Report. I'm Dominic Chu with your ETF Edge. Much has been made of this ongoing market sector rotation, but where does that stand amidst all the market turmoil in the Middle East? Joining me now for that conversation is Kim Arthur, the CEO and Portfolio Manager over at Main Management. And one of the things, Kim, that you do is run a sector rotation fund. So talk to us about how that sector rotation is playing out vis-a-vis what's happening in the Middle East.
Great, Dominic, thank you very much for having us. And a big shout out, first of all, to SIBO, which I'm sitting at here. They're a great partner of ours, and we have all our ETFs listed there, including the sector rotation that you mentioned. What I like to say, Dominic, is the market last October had a big mix shift. What I mean by that, it went from asset light, that would be technology, communications, consumer discretion, and it's rotated very hard into asset heavy. Basic materials, industrials, and energies. Things that I like to say, if you remember back from your physics and chemistry day, the periodic table, if you drop one of those items on your toe, it hurts. So I think there's, obviously, we've had a little bit of a sidetrack here with the attacks and war in the Middle East, but I still think that thesis is in shape. And when this passes, when Iran passes, this will continue. You still have big outperformance. Those asset-heavy plays are up probably 15 points above the asset-light. So that's a big mix shift in that period here today.
And Kim, really quickly before we go, what's this technology trade going to look like in the coming months? Are people still going to flock back to it because of muscle memory?
Yeah, I think what will happen is tech is not dead. It's still going to do okay. But I think that this mix shift into the asset-heavy plays will continue. Those cycles are long dated because of data center build-out, manufacturing, onshoring, all these things that you need to kind of buy land, put metal in, put steel in the ground, and fill them with heavy things that hurt when you drop them on your feet.
All right, Kim Arthur, we're going to continue this conversation over at etfedge.cnbc.com. Kim's going to be joined by Simeon Hyman, global investment strategist over at ProShares Advisors, who will also address where cryptocurrencies stand amid all this volatility. Frank, I'll send things back over to you guys.
All right, Dominic Chu with today's ETF Edge. Dom, thank you very much. All right, coming up, more calls of the day. A double upgrade for one of Weiss's stocks and a price target hike for one of Joe's. Those trades are coming up next on Halftime. Welcome back to Halftime. Let's get to more calls of the day. GE Vernova, double upgraded to a buy from a sell at Rothschild. Headline here, Weiss, you own this one. The facts have changed. They also go on to say they expect upgrades to guidance.
Yeah, so look, I'd like to tell you this is a core position, but it's not, because the valuation, I think, is kind of high, at least compared to the rest of my portfolio. Nonetheless, I own it. What's not going to be impacted by the Iranian war or anything else is the build out of data centers and the need for energy, the need for power, et cetera. So that's going to keep on going, and that's why I own GE Vernova. Others that own it would say it's not overvalued, but I wouldn't say they took this opportunity of a decline in the shares to upgrade it, because it's held up pretty well, much to my surprise, through this whole downdraft.
All right. We're talking about a lot about the impact of rising oil on the economy. Wolf actually out with a note saying they see Costco as one of the winners, with WTI trading close to 100. They say it's 100 plus. They say expect to trade down to consumables and non-discretionary items. Joe, you own this one.
Costco has made a remarkable recovery from where it was in the fall. We're seeing a little bit of a pullback here in names like Walmart and some of the discount retailers. I would include in the conversation Costco, TJX, Five Below, Ross Stores. Those are the names that I think, as consumers continue to be value-oriented, looking for bargains, I think in retail they will be the winners.
All right, Jimmy, I want to come to one of your names, Apple. Maintained as a buy at Citi with a $315 price target. They believe that Apple can navigate the memory component price hikes much better than tiers, and they see incremental pressure on gross margins.
I own Apple, so I am bullish on it. However, I do have to point out that I own it at 1/2 the overall market weight, which is my way of saying that I think there will be an opportunity to add that other half back. I recently did that with Microsoft at 386. So I'm not saying that from here to the sky is where Apple's going to go. There might be a pullback just based on valuation. Low 30s based on the growth rate of the net income. I don't think that's the right price. But I'm not giving up on the shares I have. I'm looking to add.
All right, speaking of memory, Joe, I'm going to come back over to you. Micron, big upgrade from also Citi, actually, 385 up to 430. They say the stock has sustained gains this year. However, outperformance could moderate in Q2, I should say.
So I believe they report next Wednesday, the 18th. We want to sit and kind of wait patiently for that report before you take any action. We are long in the ETF, and a lot of our ability to be long is predicated on the remarkable momentum that this stock has experienced. It's up nearly 200% over the last 6 months. And why is that? It's because of the strong pricing environment for dynamic random access memory, DRAM. Now, at some point, the appreciation, the significant appreciation, the expectation is in 26 you could see DRAM pricing up greater than 150%. At some point that's going to level off, and generally if you go back into prior cycles, Micron has proven itself that it will peak ahead of that. So at some point in 26 you're probably jumping off of what's really been a strong train. In addition, they have to answer the questions surrounding the relationship that NVIDIA has announced with SK Hynix and Samsung. That could be somewhat problematic as well. So take a wait-and-see approach. Let's hear what that report is and get to the other side to make a decision.
All right, we're going to leave it there. Coming up next, Mike Santoli joins us with his midday word. We're back right after this. And welcome back to halftime. Taking a look right now, you're seeing the S&P just fractionally below, turning to the green. Just a short time ago, we showed you the NASDAQ now firmly in green territory. We're also looking at WTI crude right now trading at about 93.75 a barrel, well below 100, so up about 3%, but well below 100. A lot of headlines related to the oil market just being released, including G7 ministers actually meeting up to talk about releasing strategic reserves. And with that, we want to bring in I want to bring in senior markets commentator and overtime co-anchor Mike Santoli joining us with his midday. Where I got ahead of myself there, Mike. I don't know if you were listening earlier. We talked about the word resilience perhaps being overdone, and right now we're seeing the S&P trying to get back into positive territory. The NASDAQ already there.
Well, the first thing is the stock market's been trading as inverse crude oil for a week, and so it makes all kinds of sense. That's exactly what we've seen. Crude goes from 115 down to mid-90s. You're going to get this bounce. The way it's done it is interesting, and it's by narrowing out back to the AI winners. That's what's up today. That's what's supporting the market. Still got big banks down 2%. The eco-weight S&P is down almost 1%. I do think that a lot of folks came into the week looking for the ingredients where you might find a little bit of a short-term flush that meant we overdid it on the downside. The S&P futures hit the 200-day moving average overnight. Is that enough? Maybe we touched it. I do think there are some things that are lining up that suggest we've moderated valuation. Sentiment is a little bit less frothy than it was for sure. And you know, if crude's going to have peaked, if we get this buying panic overnight in oil, maybe that's enough clearance. Still, we're rallying in the S&P to levels that we were hoping last week we would hold on the downside. That's the December lows. So I don't want to get ahead of the idea that somehow it's an all clear, but it's constructive action. And resilience is based on what you would otherwise expect the market to be doing. I mean, we had a mini crash less than a year ago. Market wasn't resilient last April. It bounced back from it. It was a V bottom, but it also had an absolute mega oversold to get into it. So I guess it's a matter of semantics in terms of how we describe it.
I think the difference from last April was the volatility that you saw in the Treasury market.
Sure.
Significant volatility. I think the comfort, as I said before, this time around, is you're not seeing that. It's a really tight range for fixed income.
A very tight range. A lot of people would love to see bonds rally more, perhaps, but maybe I don't really think that's the case, because that means the market's going to rush to the recessionary scenario by having the long end yields come in a lot.
To that point, looking at the 10-year right now at 4.11. All right, coming up, final trades. They're on halftime. Stay with us. And we are back on halftime with final trades. Jim, you're up first.
So this company, you may have heard of it, NVIDIA, has sold off after great earnings, great guidance. We understand the drivers here. It's a great valuation. Final trade, NVIDIA.
I have heard of that name. Weiss, you're up.
Netflix. I think you get to play offense and defense with Netflix because it's been through the wars already. It's corrected, and I think it's on the upswing right now.
Joe T.
Live Nation reached a settlement with the DOJ. They get past that obstacle. Strong momentum heading into the summer, a lot of activity.
All right, there go your final trades. One quick look at the markets before we let you go right now. As we mentioned, the NASDAQ firmly in the green right now. We're looking at the S&P. It's pulled back a bit from the levels we saw, down about 0.25%. The Dow down over 0.5% as well. That does it for halftime. The exchange starts right now.
Frank, thank you very much, and welcome to the exchange on a huge reversal day. I'm Kelly Evans. From being down 900 points last night in the futures trade, the Dow is down only 300 right now, and the NASDAQ has gone positive. The S&P down just 0.25%, 0.5% for the Russells. Not much reaction if you just turned on your screens right now to figure out what happened in response to the oil price moves. The dollar and treasuries, a little bit more action there. The 2-year yield hitting a 5-month high. The dollar index at its highest since November of 25. But let's take a look at the oil price. This all comes amid a huge reversal lower. We're almost $30 off the highs. We hit an intraday high of $119 a barrel at about 11:30 p.m. last night, the highest level since June of 2022, as some Middle Eastern countries have been having to cut back on production. WTI crude is now at $94.50. So here's what's happening. Reuters is reporting the president is weighing easing Jones Act requirements to help higher prices. Lots of news flow, I should say, in the past hour or so. Lots of talk about the G7 and how they might respond. Let's get to Pippa Stevens with a closer look at these moves, Pippa.
A huge reversal is right, Kelly, because overnight we did get up to 119.84 on WTI, for a gain of more than 30%, now only up 3.75%. And the G7 energy ministers are meeting tomorrow to discuss an oil reserves release. And sources tell CNBC's Eamon Javers that any coordinated action would occur following that meeting. Now, Iraq, Kuwait, and the UAE have all cut production, with JP Morgan estimating there's now 3.5 million barrels per day shut in. Saudi Arabia and the UAE are rerouting some oil via pipelines, but that isn't an option for everything. Storage tanks are quickly filling, and with no export capacity, we are likely to see more production cuts. Kepler saying stalled traffic for another week or two puts $130 oil very much in play. Now, the spread between the front month and 6-month on Brent is now above $20. That is the highest in our data going back to 1990 and speaks to concerns about a near-term shortfall. Finally, continue to watch refined product prices, RBOB, and heating oil just about a little bit higher right now and up more than 35% here on the month. Not only can products not be exported from the Middle East, but if refiners can't import Middle Eastern crude, they'll start running out of crude to refine, further exasperating an already very tight market. Kelly?
All right, Pippa, thank you. We appreciate it. Pippa Stevens. So why are we seeing such a massive reversal, and can it last if it doesn't appear we're any closer to a near-term resolution? Joining us now, Denton Cintagrana is Chief Oil Analyst at Opus. Denton, it's great to see you again. And what do you think is going on with the price action, both driving us to the highs just before midnight and then coming significantly off those highs since?
Yeah, hi, Kelly, and thanks again for having me. Yeah, a lot of headlines obviously moving around, and it's funny, while we were waiting to start here, I just got a text from a friend of mine in the wholesale gasoline market and said, it's hard to believe I'm saying this, but gasoline's only up 10 cents today. So, you know, when you put that kind of perspective into it, it's been a wild, you know, not even 24 hours, but basically 12 and a half hours. But again, headlines about the G7, possible levers that the administration is looking to pull to help with stem the price of gasoline at the retail level. And again, diesel's maybe getting some talk, but again, we could see $5 diesel by the end of the week if something doesn't change real quick.
$5 diesel. Do you think if we're $4 is now a foregone conclusion at the gas pump?
I think it's going to be pretty close, but I think, you know, again, unless we see something happen quickly, yeah, all signs point to $4 a gallon. That would obviously be another 50 cents or so higher than where we are right now. But again, prices are been trending higher. Now, if something happens and, you know, all this ends, I do think retail gasoline prices are going to kind of stay in this area. They'll probably plateau or move up a little bit. But
again, without much change, yeah, $4 by the end of the week is certainly in the crosshairs.
I think we should also show the price action in 2022 when it was about 12 days from when Russia attacked Ukraine for us to hit the highs, which was then around 130 on WTI. And it took 148 days, as Connor Cunningham points out. He's an airline analyst over at Melius. 148 days to get back to previous levels. And as we hear about the complications this time with shutting down production in the Gulf, you could restart it and only get to 80 or 95% of previous levels if it goes on for a couple of months' time. So, the challenges are compounding the longer that the strait effectively stays closed. That said, again, we are almost $30, about $20, $25 off of the highs from last night. Denton, why do you think that is? G7 talk?
I think that's part of it, but also, again, markets got way high. It could be some profit taking. There's a lot of things that could be kind of driving this. But one thing is for certain, this is all taking place in really high volume situations. Crude oil trading has been, some of the most active that I've seen in my just over 25 years with Opus. So a lot of volume moving around. I think between Brent and WTI, it was routinely over 6 million contracts several days last week. So a lot of moving pieces right now, and we're just gonna have to keep waiting to see where we shake out.
Perhaps we can show the futures curve. There was talk several days ago about the Treasury shorting oil futures as an action to drive prices down. Could something like that be happening now so here's the forward curve. Look at the months there. April 95, May 91, June 86, July 81. So kind of pretty consistent action across the board, getting into the back half where people are still expecting prices to be lower. But could involvement by the Treasury, or even just talk of that involvement, which they've said they're looking at it, but there was no near-term plan to do so, could that push oil down in the way that we've seen in a trading session like today?
Yeah, the jawboning could certainly be helping, kind of keep prices at bay. But man, I think that's pretty dangerous for the Treasury to come in and start shorting oil at $100, $110, $120, considering what the fundamental picture looks like. I mean, could you imagine if the U.S. Treasury Department got a margin call?
Right.
Hard to believe what would happen there.
Yeah, we added $10 trillion to the national debt because oil went to 200. Do you think 150 is still on the table at this point?
Yeah, the longer this goes, I do think that 150 level is not out of the question. There's some real desperation out there. It's not just the futures market. You're seeing some physical markets really kind of catch up to these moves. I'll give you an example. Alaska North Slope crude out of, obviously, Alaska, last week was trading at a premium of $8.30 to the Brent futures contract. About a month ago, that was about $1 over. So some desperation for physical oil is coming in out there. Mars crude out of the Gulf Coast is several dollars over WTI futures. The WTI at the Houston hub for export, about $2 over the WTI futures market. So yeah, there's a lot of demand for U.S. crude oil, and there's going to be a lot of demand for U.S. refined products as well.
I'm glad you said that, and perhaps we can show, I don't know if we have the actual spread between WTI and Brent, but one of the interesting things that happened last night, when our oil price, WTI, peaked at around 119, it was the same level as Brent. There was a 20-cent spread, which was the narrowest in years, probably going back to COVID or thereabouts. Usually there's a $5 or $6 spread, and some of the analysts in the market say they think this is because when there's literally a physical shortage of Brent, international markets are scrambling to get a WTI, a substitute, just to get those physical barrels. Do you, A, think that's what's going on here? And B, if so, it means that we're now going to pay a premium here in the U.S. because, again, of the shortages that are being caused by this.
Yeah, no, you're absolutely right, Kelly. And watching the market last night, I'm like, oh my goodness, WTI for April is trading over May Brent right now. It was a few pennies here and there, but again, I don't think that's something that's happened in decades. Actually, it went back into history. It happened on one day in 2020, but it was the day the Brent contract was expiring. So, kind of throw that out the window. But, it was more consistent back in the, 2008, 2009 era where WTI was over Brent. But ever since, kind of the shale revolution, Brent has been the clear leader versus WTI. So to your point, yes, this is a sign that there's demand for U.S. physical crude oil. It's lifting. Put it this way: this is a tide that's lifting all boats. So now, while U.S. crude oil supplies are I don't know if they're exactly comfortable. They're above where they were last year, below the seasonal norm. Gasoline is certainly above the seasonal norm. But everything, again, the tide that lifts all boats. So everything is going to take place from a higher price point.
And then finally, in terms of this reversal, in terms of WTI being back around 95 right now, What has to go right for us to stay at these levels? Because as far as I've heard, this is not because there's suddenly more transit through the Strait of Hormuz. So these issues, these shut-in problems remain. It might be because of a globally coordinated SPR release.
Yeah, that seems to make sense to me. Kind of going back to 2022, that's what helped bring prices back down from that $130 type level after Russia invaded Ukraine. It was the coordinated releases from strategic reserves that helped start to bring down the price. Maybe the market is kind of front running that a little bit here to see what happens tomorrow. But again, I think if the U.S. does release from the SPR, it's going to be oil that eventually gets exported. I think refiners here in the U.S. are fine and comfortable from a supply standpoint. Over the past 10, 15 years, the U.S. has really kind of weaned themselves off of Middle Eastern oil to the point where it's maybe 8 to 10% of weekly imports. Obviously, Canada and Mexico are two key suppliers to the United States. And, stay tuned. But over the next, couple of years, you're going to see more Venezuelan crude come to the U.S.
All right, Denton, we'll leave it there. And thanks so much for your time.
Thanks,
extraordinary 24 hours. Denton Singlgrana joining us there from OPIS. While the markets appear to be stabilizing somewhat, the situation overseas still isn't, and it doesn't appear it will be anytime soon. Iran named Mojtaba Khamenei as its new supreme leader, who is expected to further the former Ayatollah's hardline approach. And while many on Wall Street thought the president would attempt to de-escalate the situation on soaring oil prices, that so far doesn't appear to be the case. In a Truth Social post last night, Trump writing that rising oil prices are a very small price to pay for our security. Let's bring in Jonathan Panikoff for more. He's director of the Scowcroft Middle East Security Initiative at the Atlantic Council. Jonathan, welcome to you. And so where does this go from here? Just in terms of the president not backing off, but the markets responding with a big sigh of relief. I mean, if you told someone last night when WTI was at 119 that the NASDAQ would be positive right now, it's pretty hard to believe.
Absolutely, and thanks for having me, Kelly. Look, I think the reality is, as the previous guest said, look, I think the G7 announcement obviously is playing a significant role here. That may change tomorrow if the ultimate decision goes the opposite way. But at least for now, I think it's calmed things. The long-term problem is there doesn't seem to be a meaningful off-ramp. There's no reason to believe that the new supreme leader, Ayatollah Mojtaba Khamenei, the son of Ali Khamenei, is going to be looking for an off-ramp. I think the Iranians actually think they have to stay in this for their own long-term deterrence and their own long-term ability for the regime to survive. It doesn't look like the president is looking for an off-ramp, and so we're stuck a little bit until somebody makes a decision, and that's what the Iranians are counting on. What they want to do is increase pressure on oil producers throughout the Gulf. Hopefully, in Tehran's view, they in turn will then pressure President Trump.
The president is also now calling a 5:30 p.m. news conference at Trump National Doral in Miami. Then he mentions he's going to Speaker Johnson's fundraising event. Prior to leaving for D.C., he's going to hold a news conference at 5:30 p.m. What might he say? So far in interviews and in comments and in his Truth Social posts, I guess to add some nuance to the boots on the ground idea, he did say in that interview, he was asked specifically about uranium and kind of how to get it out of Iran. And he talked about doing so. And then he talked about if the air bombing continued until they basically had no responses left, maybe boots on the ground could go in to do something like that. So perhaps that's too much nuance, perhaps it's not. Clearly, the Defense Secretary Hegseth hasn't really ruled it out either. So that goes in a direction where I think people worry about the possibility of a protracted conflict that doesn't have a clear or swift resolution.
Yeah, I mean, I think for good reason. Look, there's kind of two options here. One is that the president looks around at everything that he's accomplished, the destruction of a lot of Iran's naval forces, the fact that the nuclear program, the ballistic missile program have been meaningfully diminished over the last 8 or 9 days now. And he says that there's going to be an earlier resolution and declare victory. That doesn't seem to be where he is right now. That could change. The opposite side, though, is if you get to a boots on the ground scenario, it's probably not like Iraq, for instance. We're talking about hundreds of thousands of troops. It's probably a specific mission, but that's not an easy mission. That's an incredibly complex mission to try to secure the uranium. It's not quite clear where it's being held and whether or not it's been moved. It's an incredibly dangerous situation. And of course, the other place that you could do it that would probably be easier, but no less concerning, is Karg Island. And to try to create an opening with perhaps Gulf forces, if they were willing to join, to have some sort of operation at Karg Island, to take it over, that would be more limited, obviously, and a little bit easier because of the geographic confines, and might also be helpful in terms of oil exports from the Gulf.
Given Iran's severe reaction across the Gulf, especially on the UAE, you know, and I was speaking with someone who was in Dubai last week, and he was like, yeah, it was pretty rattling, sending videos and showing, you know, these drones and missiles and the interception happening over the sky. And, you know, everyone thinks if this passes, that's not going to be an existential issue for Dubai. But to watch the response there and across the Gulf, you do wonder, and I'm curious for your take on this, could we get something like an Abraham II Accords to come out of all of this?
I think maybe long term you could get there. The challenge fundamentally is that the day before this conflict started, Gulf states and their leadership and even the people were really, really angry at the Israelis and at the U.S. for even considering this type of operation. They went to bed that night after the first day really infuriated with the Iranians. And I think the focus is on the Iranians because they really have been shocked at the fact that the Iranians have fired on them, and not just done so minimally, but extensively, and really undermined their own economic futures in a way that's just not acceptable, understandably, to Abu Dhabi, to Riyadh, to others. The problem is, I don't know that the anger on the U.S.-Israel side will have completely dissipated. I think it's being masked over a little bit. But there will be a meaningful question, look, that at the end of the day, can they work together more fulsomely, that even if you don't get an immediate Abraham Accords Part 2, can you at least start to walk the pathway? And that's possible.
Or maybe to ask it differently, forget Abraham II and Israel's involvement per se, but could those countries do something together to kind of build a more muscular response and tone now too? In other words, to kind of continue the fight that the U.S. and Israel have started. Have they created, in a sense, allies against Iran here, or no?
I think that it certainly unified the Gulf. If we think back to right before the conflict, all of the talk was about the massive division between the Saudis and the Emiratis, and nobody's talking about that right now. So look, it's clearly prompted greater GCC unity. I think the challenge fundamentally, though, becomes at the end of the day, despite the threats that we've heard from Saudi Arabia, we haven't actually seen a willingness to strike back from the Saudis, from the Emiratis. They're trying to balance this. What they don't want is to be in a position where they actually undermine themselves and accidentally extend this conflict. The Gulf wants this over as soon as possible. So if the Iranians keep firing, and especially if they keep going after civilian infrastructure, energy infrastructure, then it would not be a surprise that eventually, a week, 2 weeks from now, maybe a little shorter, the Gulf countries work with the U.S., work even behind the scenes with Israel to say, look, we're going to have some sort of response and we're going to do something together. But right now, I think what they're really hoping is that they can just outlast the Iranians. That's going to be a tall order, even from the, frankly, a defensive perspective, the number of interceptors they have. There's a lot more variables and questions here remaining than I think answers as we go forward.
Finally, and we appreciate, Jonathan, you've been generous with your time, but for the G7 meeting that is reportedly happening tomorrow, Eamon Javers has been reporting on this, possibly a joint SPR release, release of oil reserves that could help kind of blunt the impact, and maybe that's why the oil price is front-running that today. But what else needs to be on the table here? There were, some of that G7 are pretty upset about this conflict and might have, I'm thinking about the Europeans to some extent. And I'm curious what else you think might come of this, and if even an SPR release, if that is an obvious place where they can all come to agreement, but what else needs to be discussed?
Look, obviously you're right. The SPR is going to be the number one thing, and maybe it'll get you a few weeks. The real question, though, is I think where you're going to have, especially the Europeans coming, is saying, okay, well, what is the actual long-term plan here, President Trump? In other words, what is going to be a satisfactory end goal that's going to allow you to find an off-ramp to say that we're going to end the war? And I think the question for them, remember, look, when this started, the E3 basically said we had nothing to do with this, and very quickly, in about 12 hours, as they saw how much the Iranians were striking throughout the region, said, no, we're going to have to play some sort of role. They don't want that to be a sustained roll. It can't be a sustained roll. I think the biggest question is going to be a strategic one about where the off-ramp actually is right now, where it goes, and that's going to be a question for President Trump. Whether or not he has the answer, I'm not totally sure, but we'll find out tomorrow.
All right, Jonathan, really appreciate it. Thanks.
Thanks so much.
Jonathan Panikoff with the Atlantic Council. Coming up, our economist says don't let stagflation fears overshadow some green shoots in the economy, even with what's happening on the oil front. We'll tell you what they are and what it could mean for the consumer. But first, software outperforming semis last week by the widest margin on record, and it was software's best week since April, while it was the worst since April for the chip makers. Will that trend continue? Could we see a reversal? The Exchange is back after this.
This is The Exchange on CNBC.
Welcome back to The Exchange. Stocks are well off session lows. The NASDAQ turned positive briefly, although it's now back down by 0.25%. The Dow's down 431. Now, tech is the best performing sector today. You can see the sector is in the green, and it's up by about 0.25%. And that's where my next guest is focused, and he's remaining bullish because he says historically oil shocks like these don't change consumer behavior long term. Let's bring in Michael Sansatera. He's Chief Investment Officer at Sylvan Capital. It's great to see you.
Great to see
Give us
Kelly.
the ATL perspective, Atlanta, that is. So let's take a step back and just tell me, as a market participant, what do you make of the past, 15 hours or so?
Yeah, it's been crazy to watch the price of oil and the futures in particular, and all the consternation that it caused in the market. And then how short-lived it was,
Yeah.
right? I mean, you saw, 119
Right.
after hours, and now we're down sub $95 a barrel. So that tells you that it's happening fast, and it's hard to price in quickly. I think short-term, that's really just made the risk on trade questioned, right? Are we still in good shape? Are we fundamentally still going in the right direction, or is this going to derail us in some fashion? And ultimately, statistically, it hasn't.
Prior to this, the whole question was to what extent kind of the Mag 7 or tech are part of that risk on trade. Obviously, anything in the AI supply chain is, but some questions about like a rotation in leadership. What was your point of view kind of prior to this breaking out?
Yeah, I think we've looked at the large cap tech stocks as kind of a deal now. Most of them, NVIDIA in particular, the one trading sideways for 6 months. You go back 6 months once it was 38 times forward earnings. Now it's a market multiple, 20 times, 21 times, trading, earnings growing 60% plus. We think that there's opportunity there. This is the kind of gut check you get occasionally, and you've got a war in this particular instance to exacerbate concerns around the AI slowdown trade. It's a good opportunity.
So now we'll call it the Iran war or whatever. This has now increased your conviction in buying basically the Mag 7 NVIDIA especially?
The tech winners in the AI chain, NVIDIA is one, Palantir and Software is another. There's a handful of these stocks that should continue to beat expectations, force people to realize what they're really looking at longer term versus this short-term shock of what the war is doing with consumer sentiment, with the price of oil, and all the pieces that have been negatively affected.
Do you think it's just a coincidence that software bounced back as this was all happening?
Software was really oversold,
yeah.
So I don't think anything was drastically different there. You've got some long-term franchises there that are not going to zero because of AI, and I think there's some longer-term buyers stepping in.
As a tech investor, largely, what would you say to those who are trying to figure out what to do with the space? It's hard to get a lot of clarity on what's going on with some of the private portfolios, but you have to imagine the publicly traded names are maybe some of the better ones of the group. So they've traded down a lot, obviously, but then they've come back a lot in the past 4 weeks.
Exactly, and I think it just tells you what the volatility looks like, which we've been kind of calling since day one this year. You've had 3 good years of equity returns, particularly in large growth, particularly in technology. Now you're seeing this year starting off with some bounces, and that's okay. That's probably pretty normal. I think longer term, though, these are opportunity sets for tech. The Russell 1000 Growth Index that we bench against, at Sylvan Capital is 50% tech. So you've got to kind of get that right, and these are good opportunities long term.
Getting that right includes some of the high flyers like Micron and those names, or?
No, we haven't done the memory names. We think they're extended, but we do own ASML in semi-cap equipment as a lithography player and a big supporter of all those increased capacity at all those companies.
And there's momentum in some. We've talked to these companies on the show. Would that kind of make your cut or no?
That's more of a mid-cap growth strategy, which we also have, but not in large cap.
Okay, understood. Away from tech, you still own Eli Lilly. That obviously is an amazing. It looks like a tech stock if you just look at the multiples
right.
and kind of the margins. I'm sorry, the margins and the growth rate. Just why is that in here, and are there any others from other sectors that you kind of move up the list as well?
Yeah, we've liked Lilly for a few years now. On 2021 when we bought it in the focused growth strategy, and it is on the GLP-1 and weight loss process therein. Novo has struggled, and you've seen it in the stock price. You've seen it in their results, stock by stock. So we think that's still the best positioned player. I think in April you'll see orforglipron, which is Eli Lilly's oral for Zepbound. That should really take some market share, really set a pricing floor, and probably expand nicely into Medicare under a government dime, which we think makes the market quite a bit larger.
And finally, on the oil price shock, then you're viewing, I saw your thoughts there a moment ago, is kind of a serious but ultimately passing thing for the economy.
Yeah, very serious, deadly serious, war serious. So it's really a matter of how long, how severe. In our mind, what's the messaging? The administration has to get the messaging right. If it keeps bouncing back and forth, it's risk off.
Interesting. You really think it goes that? So even the comments this afternoon, the comments in the next couple of days?
All the comments matter.
Yeah.
Yeah. I'd say it.
So true, isn't it?
Yeah.
Michael, thanks. Appreciate it
Great
today.
to see you, Kelly.
Michael Sansatera with Sylvan Capital Management. Coming up, the depreciation dilemma facing Silicon Valley. Financing the AI build-out has taken a toll on Oracle's debt load. The shares are riding a 5-month losing streak, down 50% from their record highs. We'll look at what it means ahead. As we head to break, here's a look at some of the names falling to new multi-year lows, and that includes Builders FirstSource, Brown-Forman, Pool, Lennar, and BXP, formerly Boston Properties. More of the biggest movers when we come back. Welcome back to the exchange. We're not at session highs or lows, but we are still down across the board today in response to the big shock in oil prices last night. Dow's down 472 at this hour. NASDAQ down 0.25%. It's a half-point drop. 6,700 on the nose for the S&P right now. Remember, we peaked just over 7,000 at the all-time highs in late January. And here are some of the movers this hour. Jefferies getting a downgrade from overweight to equal weight over at Morgan Stanley. They slashed the price target to 49 from 78. They're citing an increase in uncertainty around credit. Of course, that's been dogging Jefferies around credit risk and legal risk after some of the bankruptcies that we saw last year. There's been a little bit of exposure there. The shares are nearly 50% off their recent highs, though, and the firm does acknowledge a lot of this could now be priced in. The cosmetics names also getting hit today, a triple whammy of higher input costs, shipping expenses, lower consumer demand. That's weighing on shares of the likes of Ulta, Coty, and ELF. And CF Industries is hitting another all-time high amid the uncertainty around traffic in the Strait of Hormuz. That region accounts for half of the world's urea exports and a third of global ammonia exports. And shares of this fertilizer name are up 20% or so in the past week. To Julia Borston now for the CNBC News Update. Hi, Julia.
Hi, Kelly. Officials in Kenya say the death toll from floods over the weekend has climbed to at least 42. Intense rains washed away vehicles across the capital of Nairobi and disrupted traffic at the country's largest airport. The government ordered relief food from its National Strategic Reserve for affected families. Search and rescue operations are still underway. Viktor Orban says he sent a letter to EU President Ursula von der Leyen urging the opening of Russian oil to the continent. The Hungarian leader, who is friendly to Russia, said the war in the Middle East and the Ukrainian blockade of Russian oil has caused prices to, quote, rise explosively. The Iran war pushed oil prices above $120 per barrel briefly as Gulf states cut back production. And 23 players, including Brazilian star Hulk, were ejected from a Brazilian soccer match yesterday after a massive brawl. The fight occurred with just about 30 seconds remaining. The record for the most ejections in a match is 36, according to the BBC. Back over to you.
All righty. Thank you, Julia. Coming up, stagflation is the word of the day on Wall Street, but Roth's Michael Darda says don't underestimate the macro positives in this economy. He'll tell us what those are next. And as we head to break, check out Paramount Skydance down 7% today now. The worst name in the S&P after Wells resumed coverage of the stock with an underweight and a $10 price target. Firm not a fan of its high leverage at a time when NFL rights are being bid on and companies need to invest around AI. P-Sky shares are down 17% now in the past week. Stay with us. Welcome back to the exchange. While some firms are raising the prospect of stagflation or even a recession now as a result of the recent oil price spike, my next guest says there are some important macro positives that can help cushion any blow to the economy. Let's bring in Michael Darda. He's the chief economist and macro strategist at Roth Capital Partners. Mike, it's great to see you again. And first of all, I just want to know if you think these positives are still strong enough to offset what we've seen over the past 24 hours.
Thanks for having me on, Kelly. I think so. I mean, look, it's going to depend how long this goes on, because the longer it goes on, the more disruptive it is. So I don't want to, discount that and seem like a complete Pollyanna here. All of that said, the U.S. economy in particular, I think, is pretty well positioned here. And we went into this shock with pretty strong economic momentum. That payroll report obviously was a shocker to the downside, but it really contradicted a lot of other data that was much stronger. You still have tracking estimates for the first quarter, underlying real final sales growth running at 2%. Some of the weekly data, that can proxy for GDP growth up at 2.5%. And let's not forget, at least since 2018, that previous inverse relationship between oil prices and GDP has actually vanished. The U.S. has been a net exporter of oil and refined products since 2018. So we're more insulated here than what we see in Europe and Asia. So that's all positive. And it seems like we've got a bit of a productivity boomlet underway. Trend productivity, or at least if you just take the average for this cycle, so far we're running at about 2.3%. So that's 0.7, almost a full percentage point higher than the average of the last business cycle. And that's really the dominant force over any longer period of time in terms of lifting real income per capita, per household.
I'm glad you highlighted it, because it's that has definitely been flying under the radar. But so we have better productivity, lower share of the wallet going to energy. We're a net exporter in petroleum and energy now, so we benefit in that sense. So there's two kind of big risks I see. I'm curious what you would say about each one of these. One is just that consumer confidence seems to me like it tracks the oil price. I mean, 2022, that was certainly true. I'm curious if we get this big spike now, if people will react negatively, either in sentiment or in spending. And then the other is around the Fed. Really, really curious how they might respond when CPI, admitted it's not their preferred gauge, goes up by a point, when the 10 years where it is. So both on the consumer and the Fed response, what are your thoughts?
Well, on the consumer, I mean, the sentiment figures have been in the doldrums for some time, so they could certainly get worse, but that's not really new. I think where the risk would be probably is more on the high end consumer. I mean, that's the dominant force in terms of total consumer spending. And so far, I mean, the S&P 500, it's certainly been, down a bunch of days in a row, but it's really not down that much in percentage terms from all-time highs. And I think that speaks to the economic resilience. So if that starts to change, then that's more concerning. As it relates to the Fed, I mean, if we think back to the oil crises of the 1970s and 80s, even going into the 1990 or 2000 recession, the Fed was jamming short-term interest rates up 4 to 10 percentage points above the inflation rate, which is not happening now. The Fed's actually been trying to support the business cycle through some of these previous shocks, in particular with the tariffs last year. So, I think a really important underlying aspect of what's happening here is bond market inflation expectations are pretty steady. Little upward pressure at the shorter horizons, but the 10-year horizon barely budging in terms of inflation expectations. That was not the case in the 70s. And you had NGDP growth going berserk in the 70s at a double-digit pace, also not happening now. So the Fed's in a very good position here to support the business cycle if they need to, or at least not to overreact and tighten policy inappropriately and then throw us into a recession for no reason.
So maybe we can see, continued cuts or trims in interest rate. And Nancy Lazar made this point too, that core inflation declined during the Gulf crisis, even when the headline went up, because at some point you only have so much purchasing power. So you've made some strategic kind of market recommendations, and I thought one of them was energy, kind of coming into this year. Do you stick with that sector now? What are kind of your thoughts about the investment implications?
Yeah, absolutely. I mean, so I think energy still belongs in the portfolio, but this is not the time to be chasing energy or getting super aggressive in buying energy, in my opinion. I would look at some of the areas that have sold off sharply with this crisis. So one old economy sector that was doing quite well until last week was the basic materials sector. Fell 7+% last week, is down again today. So that's one that that we've been recommending. If you're have a stiff upper lip, I think the transports, they've obviously been hurt by this. So that's a higher risk sector, including the airlines fell 10+% last week. So for those, I think it needs to be a small part of the portfolio, and you need to be able to weather some pain. But the payoffs could be big as well if if investors are patient there.
And the technology front, that's leading the way. But do you think that's a kind of one-off response, almost like a flight to safety thing because of the conflict, or is that going to be longer lasting?
Yeah, very interesting. I mean, the infotech sector has been holding up the market over the past week, right? I mean, it outperformed the S&P 500 last week. It had been a drag on the market, and it's almost 30% plus of total S&P 500 market cap. So that's actually been quite helpful. We came into the summer when we started to recommend the rotation into some of the old economy cyclicals. Infotech forward PE multiples were above 31. Now they're at 23. So much for the tech bubble, right? I mean, in 1999, we peaked at a 55 forward multiple. So strong earnings estimates growth, and then the previous pullback in the Infotech index and share prices have really lowered those valuations. So I would not throw Infotech out of the portfolio whatsoever. I think it belongs in the portfolio and has been helping the overall S&P 500 here, which is a good thing.
Much more supportive view, even with this oil price spike of the economy and the markets too. Michael, thanks. Appreciate it today.
Thank you.
Michael Darda with Roth Capital Partners. Coming up, airlines are lower, as Mike just mentioned, as oil tops $100 a barrel. It's below those levels now, but we still see United down 2.5%. It's the worst performer in industrials today. We'll talk to the CEO of Air Lease, the world's second largest plane lessor. Talk to him about what he's seeing in the Middle East and with rising jet fuel prices. We'll be right back. Welcome back. Thousands of flights have been canceled, jet fuel soaring. Ticket prices have spiked since the Iran war began, and obviously the danger level has picked up. My next guest has a unique look into how this upheaval could play out across the airline space. He's the CEO of Air Lease, the world's second largest aircraft leasing company, whose clients include Delta, American, Virgin Atlantic, and Emirates. Here for a CNBC exclusive interview is John Pluger, along with our very own Phil LeBeau. Phil?
Kelly, thank you very much. John, she set us up perfectly.
She did.
You've got about 500 aircraft in service around the world.
Yes.
We'll talk about those that are in the Middle East. But let's talk first off with the surge in jet fuel prices.
Of course.
We've been here before.
We have, unfortunately, we have, yes.
And so from your perspective, how worried should investors be, especially those who look at the airline stocks?
Yeah. Well, to your point, we have been there before. We're pretty early on in this conflict, a little too hard to tell. From the consumer perspective, for sure, we will expect to see higher airfares nudging up to cover this increase in fuel prices. But you know, it was this kind of a fuel price surge that spiked the new generation of aircraft with a new generation of engines. Those are out there and flying all over the place. Forward bookings, from what we can see across the airlines, have not been impacted yet.
And let's talk about that, because when I talk with other executives at this ISTAT conference in San Diego, I've yet to hear anybody say, uh-oh, this is a repeat of what we've seen during past jet fuel prices.
Yeah, no, I think it's a little premature to say that. And so, you know, the forward bookings are continuing. Airplanes are not being parked en masse for any reason. They're all still flying. So I think we just have to wait and see how this plans out. The airline industry has learned to deal with high fuel prices, and the question is, how long will it be? So far, I think it's a little premature to raise super big alarm bells.
So you've got about 8% of your fleet are with carriers in the Middle East.
Yes.
And a lot of people have heard about Dubai's airport roughly shut down. Others are not really at full capacity right now.
Yes.
What's happening with most of those planes? Are they parked? Are they just flying in other areas? What are your customers doing with their aircraft there?
Mostly they're keeping them ready for flying. They're not parked in what's called long-term storage, meaning that they plan to continue to fly all those aircraft. And leisure traffic will certainly book away from the Middle East right now. They'll go to Asia, the Americas, like that has always happened anytime there's a regional conflict. Business traffic, we'll have to see how that plays out. But again, it's so early to tell. But one thing I can tell you for sure is this industry has proven time and time again it is very resilient. The airlines will work through this. The consumer is going to have to pay some cost in ticket prices, but a little premature to really sound the red flags.
We were going into this year expecting record profits for the airline industry in 26.
Yes.
What's your outlook now?
I think that'll be dampened a little bit. It just, again, it's a function of how long does this last and how long will oil prices stay at this spike. It's really, really hard to tell at this point.
Your customers, we were talking before we went on the air.
Yes.
Narrow bodies have long been a big focus, but increasingly they're looking for wider body aircraft.
Wide body
What's
aircraft.
driving that?
I think a couple of things, Phil. Number one, there is some concern yet about when will the 777X be certified. Number two, you have to remember across the lessor spectrum, and we lessors supply about half the world's aircraft, far fewer lessors supply wide-body aircraft. So the lessors themselves are less of a source of wide-body aircraft than they are single-aisle. And so we are seeing tremendous demand on wide bodies. We're seeing airlines that have lease expiries on wide bodies in 2030, 31, 32 coming to us saying we'd like to extend our leases now.
Finally, you mentioned the 777X.
Yes.
You've seen a lot in terms of Boeing production.
Yes.
How do you feel about where they are in terms of increasing production?
I think they're doing a good job. I think they're on track to increase production. I can tell you they have been on time on all of our MAX deliveries and our 787 deliveries this year. The quality has been much better. And they do have this ramp-up path to increase rates. And I think so far, they seem confident. And from what we see in receiving aircraft and just talking with them, I'm optimistic.
John Pluger, CEO of Air Lease.
All right, Phil.
Always good to talk with you, my
Always
friend.
good to talk with you as well.
We're going to send it back to you, Kelly,
Okay.
here from the ISTAT conference in San Diego.
I'm struck by how all the executives there are like, yep, here we go again. No one's that surprised. Even they're like, yep, we know. These spikes come and they go.
And look, Kelly, relative to past jet fuel spikes in pricing, we're not at a point yet where people are going, oh my God, the sky's falling. I mean, it's worth watching, not dismissing it, but it's not like it has been in previous in situations.
No, it's fascinating. Great timing for you to be out there with them. John, thanks for your time. Phil, appreciate it. Our Phil LeBeau with John Pluger there. Coming up, tech might be holding up the market, as you heard Michael Darda say just now, but Oracle shares are still struggling, down today and down 24% this year. And a key shift in the chips industry could now add to their headaches. We'll have those details next. OpenAI reportedly will not be expanding its data center deal with Oracle. That has shares down 3% today. Deirdre Bosa has more in today's Tech Check. Deirdre?
Hey, Kelly. So OpenAI executives, they're saying that they're instead choosing to put additional capacity into other locations because it turns out the chip cycle moves faster than data center concrete dries, and Oracle is finding that out the hard way. A source familiar with OpenAI's thinking tells me that the calculus was straightforward. The company can pursue larger sites elsewhere and double down on NVIDIA's next generation chips in bigger clusters. It couldn't do that at this particular site in Texas, so it chose to go somewhere else. Now think about what that means for Oracle. The company committed the debt, secured the site, ordered the hardware, and now the customer is saying, by the time that you're actually ready, your chips are dated and I'd rather go somewhere else. Tough position to be in. Oracle cannot afford that. It does not have the cushion the other mega caps have, and its leverage does not leave room for its biggest customer to move on. On top of that, the pitch to a replacement is not great. It's something like come lease the chips that our last customer didn't want. For the AI trade at large, Kelly, this raises a key question. Can the mega deals that are underpinning the entire build-out, can they survive this tension? Data centers, they don't move at chip speed, and Oracle may be the canary in the AI infrastructure coal mine.
Look, I apologize for having a rudimentary grasp of this, but I don't understand. Oracle, okay, if there's a chip technology issue, what does that have to do with Oracle?
So Oracle is building these data centers with the last generation NVIDIA GPUs, Blackwells, right? By the time they actually connect power, the next version, Vera Rubin, is out. And if you're a lab like OpenAI, whose whole reason for being is to stay at the frontier, and you want to use the most recent technology, the most recent NVIDIA GPUs,
right?
It's just not good enough, right? Oracle building a data center with the old ones.
In other words, is just like kind of the go-betweener, put it clumsily. But why doesn't this issue crop up for others in the data center business, of which now
Great
everybody
question.
is in?
I'm not sure that it won't. It's just going to show up and be more consequential for Oracle because it has been funding its build out with so much leverage. The other sort of hyperscalers and Meta can absorb some of this, right? They can go on and it's not kind of like a huge event for them because their balance sheets look a lot better and they're funding it with free cash flow. So with Oracle, this shows up first.
You're right. And for others who are in this game, and this goes back to the credit markets and where some of these risks are, if you're financing this, it's a problem for you as well because it's going to move so swiftly. I know we have to go, but Deirdre, thank you. It is a very important report. We'll have more to come, I'm sure. Deirdre Bosa in San Francisco. That's it for us here on The Exchange. I'll go join Brian Sullivan for a busy power lunch right after this break. Stay with us.
A stunning turn, at least for stocks. Some indexes nearly turning higher as oil falls 25 bucks a barrel from the highs. Welcome everybody to Power Lunch. As oil soared overnight, the sellers roared in, but now oil back below 100 a barrel and buyers have popped back into stocks. Crude coming off its single biggest percentage move ever in one day. But your next guest says, don't lose focus. We could easily pop higher again soon, Kelly, maybe to 150.
Extraordinary action there. And take a look at how rising fuel costs are taking a bite out of the airline stocks again. United, Delta, American, all in the red. But a rally in the chip space helping lift the broader averages from the day's lows. Broadcom, Micron, and AMD among the biggest gainers. Western Digital and SanDisk are some of the biggest movers off the lows. We'll drill down more on them coming up.
All right, so we got a lot to do this hour. Happy Monday, everybody. Let's start, though, with energy because that is the big story. Now, oil, it is still up under 4%, but wow, has it cooled off. Crude oil is under $95 a barrel. Keep this in mind, folks. Last night, when it began trading at 6 p.m. Eastern Time, oil roared to $120 a barrel, a price we have not seen since Russia's invasion of Ukraine 4 years ago. Global leaders talking about a potential coordinated release of emergency oil stockpiles. One telling a paper the G7 stands ready to release oil, but no final decision has been made. And there may also be another glimmer of hope out there. Iran's foreign minister today saying that ships should go through the Strait of Hormuz, quote, carefully. Now, that could be a sign that Iran would allow ships, or at least some ships, to steam through safely. And if so, that would dial back the risk that ships face in going through the waterway, which is still almost completely empty of vessels. Despite, though, the seemingly good news, your first guest says, don't get complacent. And he warns crude could pop again if tensions re-escalate. Joining us now is Vikas Vivedi, Global Energy Strategist at Macquarie Group. Vikas, I apologize for just completely chunking your last name. I'm sure it won't be the last time I've done something like that, so apologies. Let's talk about, though, the price of oil. First off, what happened last night and what's going on right now? I mean, a $25 turn is unheard of.
Yeah, absolutely. It's unprecedented, even for as volatile as oil is. But last night, I think the market opened to an escalatory weekend, right? Iran and the U.S. And Israel, everybody's turning it up in terms of the intensity of the kinetic activity. Felt like there was no real good off-ramps, and I think the market priced that in. And we felt, to your initial comments the whole time, the market has been pretty relaxed about crude. Now, it's obviously moved a lot, but we don't think it's priced in nearly enough of the actual risk and what's turning into real barrels lost already. And we think the countdown is days and maybe up to a week and a half, 2 weeks at the most, before you are so broken in terms of the logistics that oil will just keep rallying, right? Then it starts to get uncapped.
Vikas, do you make anything of the possible move by the Treasury to short oil futures? Do you think some of this is because of this G7 SPR release? And I'm struck by the fact that even if they do release from the SPR, we still face this shut-in problem. According to one set of analysts I read, that it could be the UAE next to shut in production, then maybe Qatar. If this goes on for 2 or 3 more weeks, Saudis might have to do something like that. And then once it starts to get shut down, as you know, it takes a while to come back online. So I'm surprised more of that isn't being reflected in the current price.
We agree with you. We agree with the kind of the way you laid it out. We're surprised. Qatar, Iraq are likely to have to shut in production very soon, meaning the next couple of days. UAE, Kuwait, probably in the next 5 to 10 days. And then Saudi, we think, has a little bit of ways to go, maybe 15 days, but we're still talking days and maybe a couple of weeks. We're not talking months before shut-ins are required.
Right. What do you make of this? So with all of that said, and again, the president has indicated he's not happy with the choice of the next leader. So it sounds like the situation is kind of people are digging their heels in, and yet the oil price is down. And yet we have this dialogue. Maybe Brian can remind me the exact phrase they used here when they said that ships could go for, has to be careful going through the strait.
Proceed carefully.
Proceed carefully. Thank you.
Yeah.
What do you make of that?
Yeah, I think maybe it's just an initial set of, putting an olive branch out, but it's still far too early. I mean, I think until the kinetic activity has been iced out and, everybody's comfortable that missiles won't start flying and drones, I think it'll be tough for the strait to go back to normal. And it's just a massive problem. You mentioned, the Treasury getting involved with the futures market. We think that will be very difficult to actually pull off. The release of strategic reserves, it's a massive amount of oil that can be released, but not fast. The problem is it's a 15 million barrel a day blockage through the strait. You could release about 2 million globally from the SPRs around the world per day. There's a rerouting going on the west side of Saudi that's getting another 2 million a day. So you are chipping into the problem, but by our math, you're still going to end up with about 10 million of a deficit, and it's far too large without the straight reopening.
Well, Vikas, so this is it. So you're nailing. Oil is kind of in some weird way just math, and I know I'm oversimplifying it, but we talk about counting barrels, right? Yeah. And everybody's trying to figure out how short the world is now from the Strait of Hormuz. For example, I can get to your 10 million number, but then we also know some ships have turned off their transponders. They basically turned off their lights. They made the run through. They risked life and limb, but they did it.
Yeah.
How clear are you on how short the world is in oil? Because I could probably make a good case for anywhere between 2 and 12 million barrels a day, but that's a big gap.
Yeah, that gap is so large. It's the difference between a massive rally to 150 and then something much more modest, right? Like retracing this move back down into even the 80s. At 2 at 12 is just, and you're right, it is a massive spread. We're of the view, based on our math, that it is closer to about 10 million once you make these adjustments, rerouting, SPR, et cetera, and then the daredevils kind of working their way through the strait. We don't think that's going to take hold unless there's something forward on a resolution.
Yeah, because I want to remind our audience that when Russia invaded Ukraine, oil rapidly went to 120. Then it fell back to the mid to low 90s. Then it went back to new highs in June. The actual highs were not hit on the act of Russia invading Ukraine. You're not saying this will happen, but you're not saying, because this is impossible here as well.
Yeah, you're absolutely right. It hit 125 in March, and then it hit 125 in June, Russia, Ukraine. And right now, the market is very focused on the administration's announcements coming out today. There's a lot of hope of an oil bazooka for managing this. And we think some of it will cause oil to trade down, but we also don't think it'll address, if the strait is not reopened in a timely way, all of these other mitigation moves won't be enough, in our opinion.
Vikas Trivedi, Vikas, really appreciate your insight and your take. Thank you very much for joining us. Have a great day.
Thanks for having me.
All right.
And we want to hear from you. Scan that QR code that we're about to put on your screen to vote in today's power poll. The question is how high you think oil prices will climb this year. 110, 120, 130, 140 or higher. Do that now. We'll go ahead and reveal those results at the end of the show. Again, just hit that QR code or visit our Power Lunch page on X. Now, let's turn to the stock market reaction, because remember, we were down as much as nearly 900 points on the Dow in the futures trade, but we've since clawed that back. We're down 429 on the Dow. The NASDAQ was briefly positive. Let's bring in Laffer Tangler CEO and Chief Investment Officer Nancy Tangler, who wants her son to be home by Christmas, Nancy, and I don't know. You have a multi-pronged stake in what's about to happen here. But in all seriousness, how are you thinking this through?
Well, I've been at this, as you know, Kelly, a very long time. And for most of my adult life, Iran has been the marginal purveyor of terror. We've had a number of geopolitical shocks related back to the country. So on a macro level, I think, and non-market related, I think this could be very good for Middle East peace for a long time if we can finish the job. And so as I put in my notes, I'm not a warmonger. I do want my son home for Christmas. But there is a time when it's time to finish. And I think we are very close. And what the market is weighing is rhetoric from Iran, which is not really in a very strong position militarily, and then rhetoric from our president, who does seem to have the upper hand from a military standpoint.
Nancy, I know we're not geopolitical analysts, but you have such a good kind of real world investor's view of things, and your oldest is a Navy pilot, in case people are wondering why we keep mentioning this. But when you say that we're close to the finish, a lot of us are looking at this new leader that they've chosen and thinking, this seems worse. You go from having the 90-year-old in charge to the 50-year-old who's now furious, more of a hardliner, who we didn't destroy as part of these initial strikes, who was able to come out of a selection process by the very group that we were purportedly going to destroy or change regime. So I'm not seeing sort of the forward momentum.
Yeah, well, I don't think we have it yet. I think that, but I think the market would be off a lot more, and oil would be up a lot more if investors believed that this was the end of the story. We're not finished. They're in a very difficult position as to the ability to defend themselves. I know they can create chaos. That is the plan, but I think we will find a way to solve this solution or solve the problem. And I don't really like saying anything other than that because it sounds pretty absolute. But I don't think the story's even close to over. This is what you would have expected if you were looking back at history. It usually doesn't get better initially, it gets worse. C.S. Lewis once said, how monotonously alike are all dictators? And I think that's what we're seeing. It's just a younger, as you point out, version with a now an axe to grind, a bigger axe. So I think, this could go on for a few weeks, but remembering too that oil averaged, it was averaging in the 70s and 80s during the Biden administration, but during 2022, it peaked and spiked at 124 a barrel. Energy is a much lower cost as a percent of every household in America and a percent of GDP than it has been in recent years, and certainly half of what it was in the 70s. So I think, we take a breath, we think, we watch it very carefully, and then we focus on fundamentals, and that's what we're doing at Laffer-Tangler.
Yeah, these are all important points, and you want to be optimistic. We want to be optimistic, particularly on a Monday, and I read that comment by the Iranian foreign minister that ships have to pass carefully as actually a positive, because he's saying ships could pass. He's not saying if you try to pass, we're going to try to blow you out of the water. It was nothing like that, and so I took it, and I think the market reacted as well in a positive way. So, Nancy, because it's Monday, we're hoping for peace. We're hoping for better outcomes for everybody. What's the best case scenario here?
That we're done in a couple of weeks, I think, Brian. And I read it the same way you did. Words matter, as we say here at Laffer-Tangler, and that was the word, pass. So I think investors need to hunker down. We're not very high or very far off the highs. There's still a lot of very good news in the economy that is separate from energy-related companies. So, of course, the Carnival Cruise Lines, the airlines, they're getting clobbered, but they always do in this scenario. And that's why you want to own a diversified portfolio, have exposure to the areas that you think are going to prosper. We still like the AI trade. We've been talking about Broadcom on your air forever as the poor man's NVIDIA. It is one of our largest holdings. We continue to like it. And there's a whole host of names in technology and outside of technology that will be able to continue to grow. And I don't think the consumer yet is going to go for cover. There is still some savings, not a ton, but for the most part, Americans are working.
We'll leave it on that more constructive note. Nancy, thanks so much for the exploring the issues and obviously the investments. Thanks, Nancy. Nancy Tangler of Laffer-Tangler Investments.
All right, so coming up, we'll stay on the story, but we're going to tweak it a bit. Could higher energy costs hit the all-important AI trade? We'll tie the two together next. It is not just oil moving higher lately. Natural gas up about 4% in the past week as the Iran war enters day 10. While our local gas is not directly imported from the Middle East, of course, about 20% of global LNG does pass through, yes, the Strait of Hormuz. And Qatar Energy, one of the largest natural gas producers in the world, if not the largest, is currently offline because of strikes on its primary facility. The U.S. is the world's largest producer and exporter of natural gas, selling to countries all over the world. And with the production problems in the Persian Gulf, it makes American gas even more valuable. That's why stocks like LNG and VG have gone up lately. But so far, overall, prices have remained pretty calm. But if this or some other event were to send the price of natural gas higher, could that hurt America's build-out of AI and data centers? Joining us now to connect the dots, Stephen Bird. He is Global Head of Thematic and Sustainability Research at Morgan Stanley. Welcoming you on set.
Pleasure.
Stephen, great to see you in person. Thank you. Is there a price point, this one or another one?
Yes.
Because the AI revolution's powered literally halfway by natural gas. Is there a price point that kills that?
I think we can absorb higher gas prices because the cost of power is a small part of the overall data center economics. Or put more positively, the value of the intelligence that we're essentially producing from these data centers is so incredibly high that we can absorb higher gas prices. What we cannot absorb, though, is risk of loss of supply. And so what we're finding is security of supply, security of making sure in all circumstances that these data centers will always have the power they need. That turns out to be a big deal. And on top of that, you want to make sure you don't impact anyone else's energy costs. That's become a huge political
I think
issue.
that it's the indirect fault where you could say, and again, we're so fortunate. We are so fortunate that our nat gas price is still so low. But I got my heating bill or whatever it was that we got last. Was it heating and electric? The numbers here, if it goes any higher, even 5, 10, 15% higher from here, because of what's going on in Iran, not because of we will look for someone to get mad at. And
100%.
if that's the data centers and it slows their development.
Totally agree. When we talk to the hyperscalers and folks in the power space, more and more they're going to go completely off grid. So they can go to politicians and say, look, we understand there's so much sensitivity. We're going to completely disconnect so we have no impact. And I think we might even go further where they provide one-way power, meaning there's power plants at the data center. And when the grid needs it, that data center will voluntarily provide additional power to the grid to lower prices. I think we're going to go one up and try to lower prices.
I think that's great. Is there any reason that that's not a positive?
Just no. Everyone wins. It takes time. There's some more engineering work that has to be done, but that's where we're headed. That's the new table stakes, is making sure you do not hurt anyone else and then ultimately provide a real benefit to the.
So we have 3 Virginians around this table. Okay, you know, I'm a part-time. I was born in California, but went to high school and college in Virginia. You part-time lived there. So Loudoun County, the capital data centers. Here's what's interesting. Loudoun County's property taxes have gone down. Loudoun County's electricity costs have gone down. I'm not singing the praises of utilities, believe me.
I'd put a data center in my backyard if my property taxes would go down.
Would you really? Would you
Jersey?
actually do that?
I mean, it seems kind of quiet and low-key.
Yeah.
I don't know.
So but the point is, this whole demonization of data centers for power costs, the data, it's a little hard to find it all the time.
Well, that's right. The studies would say for Loudoun, for example, this has been a massive economic miracle for Loudoun. If you went back 10, 15 years, that was a very poor county. And my family used to have some land there. We sold our land a little early. These days, you can sell your land for a lot of money. But I
played Loudoun County and Loudoun Valley high schools in football.
Us too. We always lost in lacrosse. So I
one
look
was
like,
black
they weren't that great.
and
I'm
red.
like,
The other one was green and yellow, I think.
Yes. Yeah, I mean, this has been a game changer for the county. But the politics in Virginia are changing. There's more opposition to incremental data center growth. That's a concern. And I see that spreading to so many states, especially
Did
up
you
here.
see the NBC poll where they asked a variety of topics, political parties, people of interest? The 3 lowest ranked were AI, one of the political parties, and Iran. In other words, AI is so unpopular in this country, even as people are obviously using it quite a lot.
Absolutely. Both power prices, but also jobs. Jobs are showing up as a big question mark as well. So this is why the data center community has got to come forward with an approach that shows a net benefit. They have a PR problem. I think we all see that. They need to change their business model. They're working to do that. The good news is there's enough economics to make that work for everybody.
Trying to flip the script. We were trying to be positive with Nancy Tangler a few minutes ago. and not positive about what's going on, but bullish, I guess, on this country.
Yes.
And if we see data centers struck, like we saw one in the Middle East recently, hit by an errant missile, or not an errant, I mean, it was intentionally targeted. You just wonder if that's bullish for the United States, because we are blessed geographically. We're kind of not near anybody else. And we got I was going to say something else, a lot of natural gas.
We do. I mean, I think as we go through 2026, intelligence is going to become the ultimate commodity, and every nation is going to want to control that as carefully as they can. So that means controlling your data centers, controlling who gets the chips. That does argue for greater presence of data centers in the United States. But keep in mind, every nation is going to try to do the same thing.
Quick question for you. So obviously China has an issue with getting its hands.
Yes.
People are talking about how much they can pivot to renewables. And in this country as well, when we talk about the Mera project in Texas, they're going to start doing AI data centers instead of Bitcoin or along with it. They're doing a lot of renewables down there as well. Where are we? Because the energy kind of transition happened. Now we have these price spikes, and then we took a step back from moving into solar, for instance. But where are we on the deployment, both in China and the U.S., of alternatives?
Yeah, it's a good question. China has an abundance of every kind of power. And that's a real advantage compared to the United States. They have an abundance of cheap, available power. Their grid is fairly robust. In the U.S., we have a shortage of both the electrons and the grid that we need. So we need both. Now, Team Trump is trying to eliminate barriers to get more power onto the grid and provide more electricity. So that is good. Renewables alone won't do it, though. We need renewables, but we also need a lot of natural gas. I'd say broadly, the permitting process in the U.S. just takes longer than China. It just takes time to get that infrastructure in place. That's why, again, I think the data center community will just take control of their own destiny, build their own mini grids that are completely separated. I think that's the direction we're headed.
Who wins then?
I'd say anybody in the infrastructure space. If you have a power bottleneck, a labor bottleneck, equipment bottleneck, the value of debottlenecking is going to go up. As the value of AI goes up because these tools get more capable, we want to eliminate every bottleneck. And what we've noticed is everybody who owns a bottleneck is getting paid more and more to debottleneck, to spend more money to provide more supply.
There was a double upgrade of GE Vernova today, where the analyst at Rothschild, who downgraded them in the fall on valuation, had to throw in the towel and say, basically, it doesn't matter. Because the demand is so strong, the upside here is still so significant.
Well said, and GE Vernova is in the middle of all of this. Yeah. Anything you think about in energy, GE Vernova is there. They're also an off-grid. We also like some of the off-grid specialists like Bloom Energy, Solaris, those kinds of names we think will do really well.
All right, Stephen, come back anytime. Appreciate
you.
it. Stephen Bird with Morgan Stanley. Meantime, the Iran war has changed the calculus for a whole lot in terms of the market and the economy. Steve Leisman joins us on the other side of the break with the ripple effects it could have on the Fed. Welcome back. If nothing else, the oil price shock does create a bit higher risk of recession, and the 2-year yield hitting its highest level since November. The street's now pricing out a second rate cut this year. Let's bring in Steve Leisman. Steve, explain all of these moving pieces, if you will. We have higher recession odds, but also higher interest rates.
Yeah, well, there's a bunch of things going on. Interest rates are subject to issues of how much supply might be coming with the cost of the war, as well as, again, the issue that we have been talking about before the war, which is returning that tariff revenue. And then also how much treasuries are seen as the risk-off trade. There's some question about that at this point. But more importantly, what's happening, I think, is some sense that the Fed may be girding for a wave of inflation here and maybe right now backing out rate cuts. And if you look at the probabilities in the market right now, Kelly, what you'll see is they have indeed come down. You can see all those yellow bars are before the attack on Iran, and now blue bars are after. See, all the probabilities have come down. Basically, if you take July, 53% being a flip of a coin, more confidence now in that first cut coming in September. And you can see right now there is no second cut built in this year so far. Even December, I think, doesn't show it quite, or maybe shows a little bit more. But right now, December, there is no second cut built in. So the market has backed out essentially 25 basis points of rate cuts here, more as a wait and see approach by the Fed initially to the spike in oil prices, not necessarily hiking here.
How do you expect, I mean, we're still a ways off from this, but how might a Warsh talk about this, do you think?
You know, I think Kevin Warsh has to talk about it. Let me go through the history of this. It's a piece I'm working on for tomorrow, so I know a little bit about it now. But before, say, the 1980s, the Fed was pretty automatic about raising interest rates eventually into oil price shocks. After that, it became what's called, and you'll remember this from the papers that you read, the economic papers, Kelly, state dependent. In other words, what's going on at the time will dictate more what's happening. But I'll tell you the fear right now. The fear right now is the Fed looked through tariffs, and now it's going to look through oil price shocks. Well, maybe you do so much looking through, and all of a sudden people become concerned the Fed is not serious about the target rate. We got inflation expectations this morning. In fact, I think I brought along a chart here that shows how 1 year ahead inflation expectations on the part of the public respond to gasoline prices. And boy, it's a pretty good fit. So that's the data we got today, the 3%. That's pretty good. It's still high, but at least it was stable. But then you look at the longer run chart of how gasoline prices and inflation expectations work together. There you go. They go up when prices of gasoline goes up. Now, the key for the Fed is the 3 and the 5 year. Those are less sensitive, but they're not insensitive, Kelly, to the longer run outlook for gasoline and oil prices. So people, if those inflation expectations remain under control, the Fed has the flexibility to hold rates. If not, the Fed will need to react.
Steve, for now, thanks. Appreciate it. Our Steve Leisman.
All right, coming up, what to do with your money right now. Your next guest helps manage $2 trillion. And he'll join us with his advice for clients next. All right, moments ago, the oil market closed, and this is amazing. Okay, oil closed up 4%. It's at 94.48. It's not cheap. Nobody's saying oil is cheap. But oil was $120. What, 10 hours ago? Last night when oil began trading, it soared 35%. The greatest single move, one-day move, percentage-wise, in the history of modern oil trading. It fell back $25 per barrel, a $50, $60 round trip for the price of crude oil in 12 hours.
I mean, it's really
amazing.
wild. You'd think if nothing else, that volatility would have the markets more freaked out than they are right now. Stocks are trading lower across the board, but the Dow's down 306 points right now, and the Nasdaq is positive. So I shouldn't say across the board. The Nasdaq's been fluctuating back and forth. Is the market underappreciating the threat here from some of these geopolitical risks? Former White House senior advisor Amos Hochstein, we talked to him just a week or two ago. He was on Squawk Box this morning, and here's what he said.
Oil prices are priced today, I think still even maybe a little bit complacently. This is the biggest shortage and energy crisis we've had in global history.
Joining us on Set to React now is Jose Minaya. He's the global head of BNY's Investments and Wealth, which he oversees cool $2 trillion or so in client assets. Welcome to you. So you have to stay cool in situations like this. Just watching the turnarounds that we're seeing over the past day or so, what do you do as an asset manager?
Yeah, look, on one end, we tell our clients, like, you can't act on emotion and kind of looking at your portfolio. You can't act sometimes even in your own politics. Yet I go back to how you kind of started the opening there on, this is amazing. I feel like every week we're waking up and you're like, wow.
Like events we've never seen before.
Events we've never seen before, things that kind of defy what I learned in school in terms of the way these things are supposed to work. Yet I think the conversation we've been having with our clients, it's a continuation, right? Had these conversations that were largely academic around, look, you should prepare for more volatility. You should prepare maybe for inflation showing up. It hasn't been here for a better half of 2 decades. And all these things now that were academic, it's an urgency now, right? I just got back from visiting with many of our top RIA clients as well as our private wealth clients as well. And a lot of the questions on their mind is, but where do we go from here, right? It's this idea around the AI story and the sell-off, the idea around private credit and alternatives. And people are trying to find, like, what is the actual truth, Sattar? Sometimes I feel like I'm part of a social media kind of thing in terms of the news that we're hearing. And look, the reality is it goes back to being well diversified. It goes back to thinking about your outcomes and the solutions that you want to get to. It's not panicking and saying, what's the best advice people get? It's the one usually where their advisors tell them, like, no, don't sell now. But there is a reality of, if you look at the sell-off in AI, for example, I think that's massive validation from the market telling you, oh, we believe this is real. This is going to be disruptive. But the market doesn't know who are going to be the winners and losers, right? I look and say it's a spending game now, right? If you believe that this is disruptive, well, the companies who are spending on this are likely going to be the ones better off. Same thing with private credit. You're hearing a lot about it.
But let's back it up. Let's back it up. Because let's say the 3 of us are hanging out on a Friday night. That'd be fun, by the way. We should
why not?
Friday night, we're hanging out. We're having a couple cocktails. And I'm like, Jose, I'm going to give you a world where we go to war with Iran. Oil spikes $20 a barrel. Inflation risks are now back on the table. Oh, private credit, to your point. Some of the biggest Wall Street firms are seeing their stock down 10 and 20%. Banks are a little bit shaky on that news as well. And yet the stock market is going to be 4% from its all-time high. You'd be like, I'm going to have what he's having.
Yeah.
But that's where we are.
But does that mean that the stock market is going to follow their lead lower, which feels like it's the or does it mean that those areas of overreaction, that you can just kind of ignore it?
I think what it means that, look, if we were having that beer, there's kind of the pontificating of what's kind of fun to chat. But if you're kind of getting serious about someone's money, it's to say, hey, look, I'm managing my kid's account. I'm going to keep that in equities throughout this tenor. Managing my parents' money, I'm going to have a different view. Maybe they're in guaranteed income. But the reality is, all this is volatility. So again, what matters now is, it didn't really matter what manager you picked, in the past. Everything kind of went up. Now it's going to matter.
Because why? What are you doing differently from others, do you think?
I think for us, it's always been around solutions and kind of looking at portfolios from that construction, going back to fundamentals. Again, the AI story is a good one. I just talked to an analyst recently, and they're like, look, we don't really know who's going to win, but we're going to go back to fundamentals and who are the management teams we think are credible here and have been there through that story. BNY had a 20 billion plus revenue, record-breaking year. It spent 19% of that reinvesting in things like technology. So all of a sudden, the spend as to what's going in here, these things absolutely matter. How you think about your outcomes, they matter. It's hard to say today, I'm going to go, okay, here's what you got to go home and do in your portfolio right now. Hopefully you had that conversation already and you're getting access to these particular
it's interesting
markets.
to hear you say you're pretty bullish about technology, and that's been a part of the market that is supportive. I mean, again, whatever's happening in software and however that shakes out, that broadly that's an area that's been holding us up.
I'm bullish on two things here, right? One, absolutely technology is part of the story. The reality is AI is without question part of the story. So one end, how do I play that is, again, the firms who can invest in it are likely going to be the winners. This whole story around diversification and alternatives, and you're hearing like, yeah, there's a liquidity need, but why did that grow? It was the concept of that was if a rainy day comes, you're gonna want some of those correlations in your portfolio. The rainy day is here, but the market is still trying to figure out how to place that illiquidity.
Well, to your point, it's raining oil in Tehran. And yet the markets are 4% off the highs. We're at war with Iran.
Massive.
And the markets, I'm not gonna say they don't care, but we're not down much.
Treating it blithely, yeah.
No, they're looking past these things. I mean, obviously, it's hard to look past oil, and you're seeing the reaction there. But the actual underlying geopolitical issues, and like, yeah, the market's kind of grown ready to look past those things. And remember, we've come into this from largely a pretty healthy global economic environment, right?
Yeah. Jose, like you said, these are the times that separate the men from the boys, the wheat from the chaff, whatever analogy you want to use. They are trying times, but we appreciate you joining us to talk about it. Thanks.
Thank you.
Jose Minaya, Global Head of BNY Investments and Wealth.
All right, let's step out of business for a second and get over to Julia Borston with a CNBC News update.
Thanks, Brian. AI startup Anthropic sued the Pentagon and other federal agencies today after the Trump administration designated it a supply chain risk, calling the move unprecedented and unlawful. Anthropic is the first ever U.S. company to be hit with that designation after seeking to impose guardrails on the Pentagon over the use of its AI products for mass surveillance or autonomous weapons. The Pentagon has yet to comment on the suit. Federal investigators reportedly believe that hackers tied to the Chinese government are responsible for a recent cyber intrusion into an internal FBI network. The Wall Street Journal reports that the scope and severity of the attack aren't known yet, but it's centered on an unclassified system involved in domestic surveillance. One of the so-called fixers in a nationwide point-shaving scandal in college basketball pleaded guilty today to wire fraud and bribery charges. Jalen Smith, who trained players for professional scouting combines, was charged with 25 others for allegedly recruiting more than a dozen players to try to fix games as recently as last season. Brian, back over to you.
All right, Julia Borston. Julia, thank you very much. All right, coming up, one of the most pressing questions of the moment, what can the Trump administration actually do about energy and Iran?
welcome back. And here's another look at oil prices, which have reversed to about $95 a barrel. Crazy. To see them up only 4% after hitting almost $120 last night is pretty crazy. Our next guest says President Trump is running out of tools to fight rising fuel prices if oil and shipping disruptions last beyond another week or two. Let's bring in Tobin Marcus. He's head of U.S. policy and politics at Wolf. And Tobin, welcome. For starters, do you know why we've seen this big move lower today?
Well, I think that the G7 statement that they stand ready to take whatever actions necessary, including a coordinated SPR release, is certainly part of it. There also seemed to be a little touch of panic in the price action Sunday night, which is obviously a very violent move upward. So I think not completely shocking to see an intraday reversal, even absent a policy story to help drive that lower.
Yeah, so again, looking towards that G7 move and what might come. Again, releasing barrels from the SPR makes sense. It helped in 2022, but the problems now are a little bit different because even if we release barrels, you got to get the strait reopened so we don't have more Middle East supply shut off. That said, apparently the president has a few other options that might be under consideration, including restricting exports, intervening in futures. We've heard about maybe shorting oil futures and things like that, waiving certain taxes, lifting the Jones Act. Talk us through those.
Yeah, so Reuters had a good report about possible options under consideration that you just ran through. Most of these, I think, are non-needle movers. Some of them, I think, are very small, very clearly symbolic, like the Jones Act waiver. That's a thing they can do, but that is very much not near the top of the list of problems that we have right now. Others would require congressional authorization, so a gas tax holiday certainly would have an impact on the U.S. consumer in a very direct, mechanical way, but that's not something that the Treasury Department can just decide to do on its own. And so that leaves the things like the SPR, like this futures idea, which we look at as a sort of a spin on an SPR release that probably makes less sense than just doing a straight ahead coordinated SPR release, which, I think would help. I mean, they clearly would help address some of the problem, but I don't think they're going to get us through a sustained period of the strait being totally closed.
No, but it's not. I mean, and I think, Tobin, my viewers and my ex-followers can disagree, but they know I hate the word closed when it comes to Strait of Hormuz, because I also know that, and we've been talking about it for a week, some ships have been getting through, Iranian ships, Chinese ships, or they're just turning off their transponders or their lights and they're risking life and limb, but they are still doing it. Do we have any idea what the real situation is with oil flows around the world?
Yeah, so I think your phrase that they're risking life and limb is exactly the issue. It is a thing they can do. The Iranians did not mine the strait in advance. Everyone we've talked to in terms of military experts has been clear, like they have not fully militarily closed the strait. And to your point, some ships have gone through, others have been struck. I think that the question is going to be, can the actions that the administration can take around the strait in terms of this reinsurance scheme and the notion of military exports, will that actually allay the concerns that maritime operators have about getting through? I think probably the answer is no, unless you can actually suppress Iranian drone activity in the region, which thus far we've not been able to. It's harder to go after those than the ballistic missiles because they're smaller.
What options, Tobin, as politicians gather with the midterms looming, what options do you think they have in terms of messaging this, and how might it go down? Again, we have the refund checks, tax refund checks. The consumer's in pretty good shape. The economy's in pretty good shape. But this does present, obviously, a huge political challenge.
Yeah, I think the political challenge is very real and very hard to talk one's way out of. To your point, we also think the consumer's in good shape. We don't think that we're going into a recession, but the economic vibes and sort of voter sentiment about the economy has nevertheless been very bad before getting into this crisis. Now, presumably, will start getting worse. Approval of the war itself has been very sharply polarized on partisan lines, as most things are in American life. Support from Republicans is in the 85% range, a little bit underwater with independents, strongly underwater with Democrats. I think that's likely to persist. Probably gets worse if we start to see more significant economic disruptions as a result of this. So I think the administration's bet is that they can get this done soon enough that the consequences will be transient and voters won't hold it against them in November, and time will tell if that's going to play out.
Tobin, thanks. Appreciate your time today. Tobin Marcus with Wolf. Coming up, the market movers of the day, including this one here that is soaring as it revives an old partnership. Take a guess, and we'll reveal it after the break.
All right, remarkable day in the markets. We talked about it. Well off our lows for the stock averages. Oil finished down 25 bucks from its high, finished up only 4%. But what about the markets? What's going on underneath the surface? Dominic Chu. And Dom, I would say you've seen everything because you ran money professionally as well. But I got to imagine that even with your just general cynicism, I'm joking, he's the nicest guy in the world, that this is a day for the record books in some ways.
So I would say yes and no at the same time. Record books on the crude oil side of things and everything else, but overall markets, we've seen this kind of downside volatility that's resolved itself a lot over the course of a trading day.
Okay,
right?
last night oil was up 25 bucks a barrel and markets are collapsing, and I'm thinking I got to call Dom Chu because we're going to end down 2,000 on the Dow.
And we didn't, just like every other day over the past week. It's interesting. But I mean, if you talk about some of the moves that we are seeing, stock individually speaking wise, the worst performing sector on the day so far is not anything tied directly to the conflict, although in some ways it is. It's financials, big banks in particular, rising oil prices, fear of a possible economic slowdown. They're hitting names like JP Morgan Chase, B of A, Citigroup, Wells, Goldman Sachs. You get the idea. Watch the economic narrative around banks. Next up, you got a stock that's bucking the overall trend. It's the mystery chart that we showed you right before the break. Shares of Hims and Hers Health surging to the tune of right now just about 41%, and that's off the best levels of the day. The online health and pharmacy company struck a deal with drug giant Novo Nordisk to sell its popular GLP weight loss drugs. The deal also ends a lawsuit between the two companies around the selling of copycat versions of Novo's Wegovy weight loss drug. And we're going to end on shares of GE Vernova, also gaining ground in a down tape, thanks in part to a double upgrade to buy from sell over at Rothschild & Company Redburn. They expect better guidance from the power generation company amid stronger demand for AI use cases and gas-powered turbine engines, amongst other tailwinds. It's also being added to the large-cap S&P 500 index, so keep an eye on those. And by the way, for those and other top calls of the day, just head over to cnbc.com/pro. Subscribers get all the detail around those big upgrades and downgrades, guys. I'll send things back over to you.
All right, Dom Chu, thanks.
You got it.
More Power Lunch. Our poll reveal after the break. Welcome back. So what do people think of the oil price from here? Let's reveal the results of our power poll today. We asked you how high that price will climb, and the majority of you, look at this, Brian, almost half of those who just responded, this is just in the past hour, think 140 or higher. The next category, 120, that got a quarter of the votes, and then a split between 130 and 110.
I didn't think it would go above $100 a barrel. I put that in a poll, and last night everyone's like, you're wrong, and I said I was wrong. But now I'm thinking I'm right.
But what about with the containment of this conflict?
I think more ships are going through the Strait of Hormuz than we think.
I think that's the most important thing you've said this entire hour, because we're all working from the premise of if the Strait of Hormuz is closed, then what if it's not?
It's never been closed. I don't like that. It's one of my trigger words. I don't like the word closed. Cerrado. You know what I mean? I don't like it.
What are you up to tomorrow?
Tomorrow, RBC Global Financials Conference. Very rare interview with David McKay, the CEO of RBC, the biggest bank in Canada. Doesn't do a lot of TV. Really looking forward to speaking with him and more.
Excellent timing for that as well. Thank you all for watching Power Lunch.
And Closing Bell starts right now. And welcome to Closing Bell. I am Frank Holland in for the Judge Scott Wapner. We're live from Post 9 at the New York Stock Exchange. This make-or-break hour begins with a big comeback. Stocks, they're well off their lows as oil pulls back from a historic price spike that sent WTI well above $100 a barrel. Here's your scorecard with 60 minutes to go in this trading session. You can see quite a bit of red on this board. You're looking at the Dow down over 380 points. The S&P down just over 1/3%. It's the NASDAQ. We saw it very briefly peek into the green earlier. Now it's just fractionally lower. Also take a look at WTI crude right now, up almost 5%. And we're going to look at some of the sectors as well here. Look at tech. It's up just about 1/3%. Energy up about 1/4%. Erasing earlier losses to move into the green. Healthcare also holding on to some gains. While the financials remain the worst hit sector in today's pullback. And check out what's happening with the treasuries. Also, take a look at the 10-year. You see the 10-year yield right now at 4.13. A lot of talk about a lack of activity in the bond market. We'll talk about that and much more because we are all over the market comeback in this final stretch of the trading day. But first, before we get to all the market action, we want to get to what's happening in the oil market. And for that, we turn to CNBC's Eamon Javers, live in D.C. with the very latest. Eamon, what is the latest here?
Well, Frank, what we know is this G7 energy ministers meeting that everybody's been looking forward to is on the schedule now for Tuesday morning. It's going to be a virtual meeting, I'm told. That is, you're not going to see ministers all around a table somewhere making a decision. But if you're looking for the G7 to sort of do a joint strategic oil release, that is the decision point where they'll decide whether or not to do that. That comes tomorrow morning, East Coast time here in the U.S. And what I'm told by sources, Frank, is the U.S. position is this. The U.S. is saying that a joint release among the G7 of 300 to 400 million barrels, representing 25 to 30% of the 1.2 billion total barrels in reserve, would be an appropriate decision. That is, the U.S. feels that's the way to go. We'll see whether the other G7 nations feel that's the way to go. And of course, Frank, we'll watch to see if the market thinks that any action taken to release from strategic reserves is enough to whet the demand that's out there in the global market.
Yeah, certainly a lot to watch there. Again, that meeting happening tomorrow. Eamon Javers live in D.C. Eamon, thank you very much. Turning back to the oil market and the price action, oil well off the highs of the day, back below $100 a barrel. Our Pippa Stevens joins us now with much more on that part of the story. Pippa.
Hey, Frank, it was a massive intraday move with WTI jumping 30% overnight and hitting a high of 119.48. Now trading at 94.94, up just 4%. That reversal coming as the G7 energy ministers are set to meet tomorrow, as you just heard from Eamon Javers. Now, retail traders are taking note of crude's climb, with Friday the biggest day of retail buying in the USO on record, according to Vanda Research, which said it may be emerging as the next meme theme. BTIG's Jonathan Krinsky adding that as of 12 Eastern, the fund had already traded over $8 billion in notional volume, by far an all-time record, and, quote, another sign that this is a blow-off move. Now, in terms of where oil might head next, Kepler saying stalled traffic for another week or two puts 130 very much in play. And the spread between the front month and 6-month Brent price is now above $20, the highest in our data back to 1990, pointing to concerns about a near-term shortfall. Frank?
All right, Pippa, thank you very much. Our Pippa Stevens back at CNBC HQ. For much more in today's market action, let's bring in our panel. Palumbo Wealth Management's Phil Palumbo, Citi's Scott Cronert, and Wells Fargo's Scott Wren. Gentlemen, thank you all for being here. Phil, since you're here at Post 9, Why don't we start with you? We've seen a pullback in oil prices. We've seen equities make some recovery today. Do you think that tomorrow, if we get this release from these strategic reserves from G7 nations, does that create a positive tailwind for the market? Or is the overhang of an extended war, does that still kind of loom over investors?
Yeah, for me, which I said it from the beginning, I really believe it's the duration of the war is what's going to matter most, right? So the longer the duration, the longer the issues in the Straits of Hormuz, the higher the price of oil goes, which will create economic issues. I don't know how much the release of the strategic reserves is going to make the overall markets. Maybe in the short term, maybe it's what you're seeing today. But Frank, at the end of the day, in the long term, it's, for me, it's just the longer the duration of this war, the more issues we're going to have with the price of oil and the volatility we'll have in markets in general.
All right, we're certainly seeing volatility lessened a bit today. We saw the VIX pull back a bit. Scott Cronin, I want to come over to you. A lot of things happening in the world. The Iran war being the very latest headline. You're sticking with your base price target of 7,700 for the S&P. Are you not concerned about this rise in oil prices? You're not concerned about some of this selling, whether it be oil related or even before that AI disruption related? We saw it in software. We even saw it in transportation for a day or two.
Oh, Frank, thanks for having me on. Definitely concerned. There's no question about it. The list of issues that we have to contend with right now versus where we started the year is getting larger, and Iran and certainly the Strait of Hormuz is the next on this list. So what I would say here very simply, though, is that, our view for this year has always been predicated on very strong fundamental trends. And right now, what we're looking at is a trajectory for S&P 500 earnings that is still up and to the right, and potentially is going to be enhanced a little bit by some of the strength in oil of late. So the bottom line here is we're certainly monitoring a lot of these issues, looking for that ultimate economic consequence, which we haven't seen just yet. But generally speaking, with, let's call it, over 9 months to go in the year, we still think it's a bit premature to be taking a shot at our full year base case.
All right, Scott Wren, I'm coming over to you. Just based on the market action today, I want to talk to you about financials. You see a lot of opportunity in the biggest banks. Does that thesis hold steady with the idea of higher oil prices shaking consumer confidence and perhaps impacting a lot of parts of their business when it comes to the consumer side?
Well, I tell you, Frank, I think you can do all the statistical and modeling work that you want, and then when something like this happens, you have to make some assumptions. And our assumption is that this is a temporary spike in prices, that the Strait of Hormuz will be open, maybe not to 100% regular traffic, but a lot of regular traffic pretty soon. And so really when we look at the underlying economy, we don't see a lot of negative effects. So financials have obviously performed pretty poorly here. We still think that the yield curve is going to steepen from here. I think there's going to be a better economy. We've got a 2.9% GDP number out there. I think inflation will stay moderate even with this, what we consider likely a very temporary spike in oil prices. You're going to see more merger and acquisition activity, more IPOs, more demand for loans. So for us, financials, really, we've liked financials. They did well. We all know what bank stocks have done lately. They've come off a bit. This is a good opportunity. We're looking for opportunities to take advantage of the volatility that's out there, because clearly the S&P 500 isn't all that far from the record high.
So, Scott Wren, I want to stick with that theme for a second. You say you're looking for opportunities. You say you want to add industrials and also utilities. So what opportunities are you seeing there?
Yeah, well, I tell you, here's really the opportunity, Frank, is, for us, we would be trimming energy exposure. I mean, if you're out there and you had an even weight exposure in energy recently, you're overweight now. We trim that back to a neutral weight. We would take that money, we buy large cap, we buy mid cap, we buy, in industrials and utilities, and really in commodities exposure, which we've carried some commodities exposure. Anything that's energy related, we would back that off to neutral, and we'd buy precious metals and industrial metals. So those are some of the opportunities right there. And I think that, for the market as a whole, what we would do, we want to still play that AI secular trend. That's why we like industrials and utilities. But for the market as a whole, if we get some kind of pullback here, 7 to 10% kind of range, we think that's a really good opportunity. That's when you step in there to buy the market overall, not necessarily just focusing on the sectors that I just talked about.
Scott Cronin, a lot of people are trying to figure out where they should put their money. You're overweight when it comes to tech and financials. I want to go to tech for a second. Why tech right now? We've seen a lot of disruptions in tech from AI. Software in particular comes to mind. Where are you seeing the opportunities in tech?
Yeah, so spot on. So Frank, we've already seen the sell-off on AI disruption concerns in software. We've seen the conviction in forward trajectories on the semiconductor side persist. Yet when you look at the tech sector in aggregate and the Elite 8, as we call it, your PE to growth ratio is actually the lowest it's been in going on 10 years. This is, relative to growth expectations, the least expensive part of the market. So while I hear the other, Scott, in terms of financials, which were also overweight via the banks, I think right now the opportunity is in tech, where not only do we have, I think, still very compelling growth opportunities over the next year or two, but additionally, you've sold off hardware in this key component of it, the software area, and should be less sensitive in aggregate to economic disruptions should that fall out from higher oil prices.
All right, everybody stick with me. We already got two Scotts. We're going to have two Phils in a second. We're looking at airlines right now being impacted by those higher oil prices, as we mentioned. Our Phil LeBeau is here with much more on that. Phil.
You know, when you take a look at what's happened with jet fuel prices, Frank, another day where it's up, not a surprise here, given that they've seen the scope of the increase in crude oil prices. Look at jet fuel since the beginning of the year. It's doubled in price. And for Argus Research, they've gone back in their archives and they said, when was the last time we saw jet fuel at these prices? Got to go back to March of 2022, shortly after the beginning of the conflict between the Ukraine and Russia. For the airline stocks, what you're looking at now is another day where they're going to be under pressure. And they have been, although not down as much as they were earlier today. Earlier today, they were down anywhere between 5 and 7%. Now you see they're down anywhere between 1 and 3%, depending on which airline you're talking about. And finally, as you take a look at the airline index, keep in mind the airline index is down, what, 21% in the last 3 weeks? Not even that, 2 weeks. So what you're looking at is a huge decline for the airlines overall. The bottom line is this. Here we're at this ISTAT conference in San Diego, Frank, talking with aircraft leasing companies, and almost everybody says the same thing. There's no sense that this is a horrific situation like in 08, where you sat there and you said, okay, what's going to happen with the finances for a number of airlines? Because the demand remains strong, and there's no general feeling here, at least, or when you talk with airline executives, that this is going to be an extended issue. Certainly it could be, but at this point, most people are banking on this being an increase in prices. How long it lasts, nobody knows, but they're not looking at this as being a repeat of what we saw when we saw a huge surge in jet fuel prices, let's say in 2008, and there was an extended period of time with high jet fuel prices.
Our Phil LeBeau with a look at the airlines. Phil, thank you very much. We're going to turn back to our panel right now. I'm going to come back to the other Phil on the panel right now talking to you. We keep hearing people say, whether it's our reporters or other guests, ever since. It's the biggest spike since this time. It's the biggest spike since that time. So clearly we're talking a lot about disruption. It's what you're looking at as well. You actually see a 10 to 20% drawdown in the markets coming up this year. Is it from this oil disruption? Is it from something else? What are you seeing?
Yeah, so I've been pretty clear coming into this year. There's a couple of things that I've been looking at of why I believe there could be some volatility where you could see a 10 to 20% correction. Number one is anytime you have a new Fed chair, especially Kevin Warsh, which is interesting because he's looking to bring the Fed balance sheet, I believe, down to mute inflation and bring interest rates down. With that, you're going to see volatility around that with markets. Historically, you've seen a correction around 14%. Typically, second year of mid-cycle with presidential mid-cycle with midterms, you get a correction, you get some volatility around there. And obviously with geopolitical unrest like we're seeing, you also get volatility. So when you put those three things together, coming off two back-to-back years of a great, strong markets overall, that's where I think you see some volatility of around 10 to 20% downside.
So you're seeing some volatility, but you also see some opportunity.
Absolutely.
You gave us a couple of picks. Now, this one I thought was interesting. Right. Uber. A lot of that business is discretionary. Right. What are you seeing? Of course, some of it you just have to get where you're going, but a lot's discretionary. Why are you seeing Uber as a stock to play here? Impacted by higher gas prices, impacted by consumer spending as well.
Yeah, so overall Uber is a business, reminds me of like Google with search with ChatGPT, where people re-rated Google to a lower price. It was a great opportunity. We took advantage of that. We did really well. Same thing with software with CRM right now. You've seen the software sector get hit because of Anthropic. I think Uber's like that with autonomous vehicles. That's why you're seeing it get re-rated to a level of a forward multiple of 21 times. But the reality is that Uber has done a great job under the current CEO. It's a margin expansion story. It's a free cash flow generation expansion story. Top line revenue up 20%, bookings up 22% year over year. It's turned into a great, mature business that I think will actually do well under autonomous vehicle. They've done a partnership with NVIDIA, other OEMs, and I think their network of 200 million people per month. I just think it's a great business that you could do well over time. And it's re-rated at a price where it makes sense.
All right. Scott Cronin, I want to come over to you. We just had our Phil LeBeau talking about airlines and the impact that these higher fuel prices have caused. A lot of questions about consumer discretionary spending. Some part of airline travel certainly is that, Scott Cronin. What's your view on the airlines and the take from Phil that a lot of executives believe that this is transitory, if you will, that these higher prices won't last forever and won't truly dampen consumer demand over the long term?
Well, I do think duration is key here, and that's very difficult to assess at this point. In terms of the state of the consumer, I think you're spot on with this point. Our concern, and this is why we've been underweight consumer discretion staples all years, is basically that you have a fairly stretched consumer as it is on the heels of last year's tariff impact. Some of the labor conditions continue soft out there. So while I do think from a longer-term perspective, how oil prices go, and jet fuel in particular, I think you have to presume it's on a spike right now, and we'll find its way back lower. In terms of the consumer impact on travel, I think it's going to be fairly mitigated, but I think at a level here where we just have to be sensitive, right? That we have a fairly extended consumer that's going to be looking for a trade down opportunity where it can is the biggest theme going through this year.
All right, Scott Wren, I want to come over to you. You believe, we've got to come full circle, of course, you believe this spike in oil prices is temporary. If it is temporary, after this settles down, what sectors, what areas of the market do you see benefiting from, I guess, a sigh of relief from everyone that we aren't seeing a longer, prolonged escalation, not only in the Middle East, but also a continued escalation of oil prices?
Yeah, well, I tell you, I think that for us, you're going to see good growth here in the U.S. You're going to see good earnings growth. The rest of the world's going to do a little bit better, not a lot better. And so, we want to be in these large cap and mid cap U.S. stocks. And from a sector perspective, I still think, you need to lean into sectors that are going to benefit from not only AI, but just from a cyclical recovery. And we've seen the market broadening out, big time since the middle of last October. And so I think if you have some confidence that consumer spending is going to stay up here, and if oil prices don't stay up here and gasoline prices come down, which we think is going to happen, they're going to have big tax rebates, and Americans who have jobs and money in their pocket, they're going to spend it. So I think the consumer discretionary sector, or not the sector, the consumer consumer spending, and then AI CapEx is going to be huge. Those are going to continue to be big drivers here, but it's filtering down through the rest of the economy as well. So I think you're going to see more stocks participating in terms of earnings, more stocks participating in terms of price within the S&P 500. And so, broadening market is a good thing, and I think we're going to see it over the balance of the year after we get through this oil price spike.
All right, gentlemen, we got to leave the conversation there. Phil, Scott Cronin, and Scott Wren, thank you all for your time and for your insight. All right, right now, looking at the markets. By the way, the NASDAQ very close to being in the green once again. With that, let's send it over to Christina Partsinevelos for a look at the biggest names moving into the close. Christina.
Who is at the NASDAQ? Well, let's start with Live Nation, adding roughly 4% after the company reached a settlement with the DOJ over antitrust concerns. The settlement would involve Live Nation's Ticketmaster paying roughly $280 million and rolling back some of its exclusivity agreements to open the ticketing industry to, of course, greater competition. United Therapeutics moving even higher, about 9% after its board authorized a $2 billion buyback, with about roughly $1.5 billion for accelerated repurchase agreements with Citibank, and the other $500 million available for additional buybacks just over the next year or so. Shares, though, have climbed roughly 60% just in the past year. And shares of Xenon, the pharmaceutical firm, surging about 45% right now after its seizure drug passed a key efficacy trial. Xenon said its drug reduced seizure frequency more than the placebo, and it will seek FDA approval in the third quarter. Cantor Fitzgerald and Stifel both raised their price targets on those results as well. 45%. Right.
Now that's a stock move, Christina. That is a stock move right there. Christina Partsinevelos live from the NASDAQ. Christina, thank you very much. We'll see you just a bit later in the show. We're just getting started. Coming up next, rising gas prices that could hit retailers in a very big way, the names most vulnerable to a pump price spike. And we're live from the New York Stock Exchange. You're watching Closing Bell right here on CNBC. And welcome back to Closing Bell. We want to take a look at the markets. As you can see right now, a lot of green on this board, and a big shift from just a few minutes ago. Take a look. The S&P up about 1/3 of 1%. The NASDAQ up about 3/4 of 1%. You're seeing the moves of the NASDAQ in the red most of the day. Now just moving into the green. Similar story for the NASDAQ. Big move to the upside as well. We saw the Dow very briefly turn into the green, going positive. Oh, well, it's back there again. You can see very fractionally higher right now. The Dow up just a few points. We're going to continue to watch these markets throughout the day and look for any headlines that seem to be moving the markets higher right now. Right now, we want to turn back to the recent spike in oil prices, though, and how it could take a toll on some consumer-facing names from apparel to beauty to restaurants. Pain at the pump. It might leave a group of retailers at risk. Joining me now with exclusive insights, Michael Gunther, Consumer Edge Senior Vice President of Research and Market Intelligence. Thank you for being here at Post 9.
Absolutely. So what we wanted to do with this oil price spike and resultant gas price increase is look at consumer share of wallet by retailer. So understanding for each set of companies, what percentage of their spend goes to gas every month, every year. And the point of this is to understand if gas prices were to go up and stay up, these retailers could be most at risk because some of those dollars need to be reallocated to gas instead of going to more discretionary items.
Okay. So it's basically how much people spend on gas and that they won't potentially have to spend on other goods because gas prices are rising. So why don't we start with beauty? What areas of beauty do you see possibly being impacted? Is it makeup? Is it, hair products? I mean, what could potentially be impacted?
So I think it's more about the retailer profile and what those consumers are like. So a company like Sally Beauty could be more at risk than an Ulta because, it caters to a lower income consumer. Okay. Ulta has a relatively high share of wallet toward gas among its consumers because, it's in strip malls and things like that and you need to drive there. But Sally is definitely more dependent on that type of consumer.
Well, that's kind of what I was getting to.
Yeah.
Can you talk to us a little bit about off-price retailers? That's an area that a lot of people have been talking about potentially being impacted, and we've seen a leg